Good morning, everybody. Good morning. Rob, I don't, man. I just look. Um, I don't click on the price bars because it doesn't really show. To be honest with you, one of the things you can do, Rob, and good morning, Steve, Hamid, Ed, Jeffrey, Jay, and Erla. So, if price is at 71.20, my fib is at 71.34, I got 14 ticks. So you got to do the math a little bit. Unfortunately, if math isn't your thing, 15 to 34 is, I've got 19 ticks. Can you guys hear me? Give me a Y if you can hear me, please. Anybody? Yes? Okay. Good morning, home. Nice to see you back. Glad you didn't decide over the weekend you didn't want to play anymore. Hey, Wayne, good to see you. Since Rob can't hear, I'm going to do a quick picture for him. And guys, when you're trying to figure out if you have room to get to where you're going, remember that you're doing the math from your entry, not necessarily from where price is. So I'm going to do this too. You have to know, where will I enter? How much room from that point? So there we go. Little something for Rob and for everybody this morning. Whoops. And this is one of the things that buying and selling pullbacks does for us, is it really increases the room. Can you hear me now, Rob? So Rob, you have to know where your entry is. The black tells you where the current price is. You can see trouble. That's got to be a quick math calculation. But if you're buying a pullback, well, then that increases, right? So you're always looking for, do I have room to make money from my point of entry? Not necessarily from where the market is currently. I hope that makes sense. And then when we go through rule number 3 and we talk about those entries, you'll see how it increases the profit potential. Where am I? Whew, got sidetracked. Got some new names in here too. Nice to see you guys. Oh, and then somebody jumped out. Welcome, guys. It's Monday. It's the education room. We're going to have some fun today. We're going to do what we do pretty much every day. We're going to do the same as we did Friday, same as we'll do next week. Actually, next week will be different. John Novak has the room next week. Guys, every day I go to forexfactory.com and I check news. And I don't check news because I'm worried about what the news is. And to be completely honest with you, I couldn't tell you one thing about flash manufacturing PMI or flash services PMI. But what I know without a doubt is that anytime there is a red box next to a news release, it is what's considered high impact. And high impact means that there could be somebody with an awful lot of money waiting to see what the news is. And very often this creates untradeable spikes, and it can, make the market trade 100 times faster than it was trading. And it's just a very difficult time to make decisions to read indicators. So anytime I see this high impact, for instance, at 9:45 a.m. we have it. Right about 9:40, I have a note on my desk or a reminder with Siri to just tell me, hey, stay out of the market for 5 minutes. Let it do what it's going to do. And then when it settles down, look for your opportunities. So every morning I check news. Everything that I talk about comes from the education page. Come on. And guys, we stay very, very focused in this classroom. When you go to the trading guide, in the glossary of common terms, we talk heavily for an entire hour about a high probability trade. We talk about a high probability trend trade. And this trade it's defined when each indicator, every chart agrees for the rules for the trade. And this is when the triggers are their strongest and no termination conditions exist. and there's no trouble spots between you and your targets. And this high probability trend trade that we teach, that I teach, I guess that you're learning, is a pretty simple approach to trading. And the entire goal for me, and my hopes for you, is that you use it to learn how to read your indicators. And that's really what this classroom is designed for, is to teach you to read your indicators, to get you recognizing a couple advantages. And then from those advantages, you're going to be able to trade. You're going to find your opportunities. The high probability trend trade is a trade that typically wins 70 to 80% of the time. It's also a trade that is designed to teach you to read your indicators, to give you this foundation, this core that you're going to grow from. And chart reading is about 90% of your day. Again, I like to tell the story every morning. I was in front of my screen at 5:30 a.m., 5:40 a.m. Central. My classroom starts at 8 a.m. I took one trade this morning, guys. I had one trade where my rules were met. And that's it. Just one trade. So I spent, the better part of 3 hours doing absolutely nothing, but I spent about 15 seconds in there making a little money. And that's kind of how trading is, guys. It's not who trades the most wins the most. It's in the room, Ed. We can show it later, but I posted it in the room up top. I'm always happy to share with you guys. I'm taking Ron C's trade. That's the only one I'm looking for right now. And I'm doing it kind of as an example that once you understand how to read your charts, and more importantly, as soon as you can identify momentum and a clear path, and these are the first two rules for the high probability trend trade. There's only 3 rules for the high probability trend trade. Once you understand the first 2, once you can look at your chart and say to yourself, I have the advantage of momentum because my trigger lines are strong, and I have the advantage of a clear path because no termination conditions are in my way. Once this is a part of your vernacular, once you can look at your charts and know without question that those advantages are present, you really have everything that you need to create a very solid trading plan. And these 3 rules, these 3 advantages, the first 2 are universal. These are going to carry you through everything. The third advantage that comes from the third rule is entry specific for the high probability trend trade. And rule number 3 is going to change as you change. It's going to grow as you grow. But these 3 rules that we're going to talk about for an entire hour this morning, they're going to happen on only 2 charts. And maybe I don't stress this enough in the morning. Guys, it is important to know where your rules are happening. It's important to know which chart is responsible for which rule, because what happens is a lot of people will try to take these large chart rules, these slow chart rules, and turn them into a reality on the small chart, and that's just going to keep you out of the market even more than that 90%. So we're going to use a large chart each and every morning, every day when we trade, and the large chart is going to lead the way, guys. It's going to define the direction of the market. If the background is green on your large chart, the market is going up. You should be looking for rules to be met for high probability trend trades long. If the background is red, the market's going down. You should be looking for rules to be met for high probability trend trades short. And guys, that is the easiest. That's a path of least resistance. Then it's going to define the momentum in the market. Rule number 1 does that for you with strong trigger lines. This is the first advantage that you need to learn. This is the first look we're going to study, guys, and this is probably the easiest lesson that you're ever going to get. Once momentum is present on the large chart, you're going to make sure that you have a clear path, that there's no termination conditions, and that's the market defining areas, guys. Your first 2 rules, 66% of your advantages come from the large chart. And it's a slow chart. It is using 1 bar, the most current bar, to define these things, direction, momentum, and area. Once the rules are met, guys, momentum and a clear path, the first entry that you were taught is the entry for the highest probability trend trade. And that's where the small chart comes in. We're going to take this very broad stroke of a brush, this 1 bar, and break it down into 20 to 30 bars on that smaller, faster chart. You will be able to pinpoint exactly where the market is most likely to continue. This becomes your entry for the highest probability trend trade, and you'll be able to use the small chart to reduce risk and to increase your profit potential. And that's where rule number 3 comes in. And the 2 charts are a reflection of who you're trading with or against. And I like to share this picture every morning because no matter how much we wish we had any impact on the market, guys, we don't. The market will never do what we want it to do. The market is going to do exactly what the large crowd, the big crowd, the people in charge want it to do. Our job is to just go along with them, kind of be that tag along. Like that little dog that used to hop over the bulldog in the old Looney Tunes cartoons, guys. We're going to take a piece of what the large chart creates, what the large crowd creates. And then there's the smaller crowd. And these guys like to fight the large crowd. They have a plan. They know how they're going to get paid. And they create these little shoves against everything that the large crowd is doing. It rarely lasts. 70 to 80% of the time, it fails. And you're going to be able to pinpoint that failure spot. That's going to become your entry for the highest probability trend trade. So we're going to keep it real simple. We're going to talk about 3 rules. We're going to do it on 2 charts. And guys, this is your foundation. We're laying the foundation for you to be able to read indicators, for you to be able to build your trading plan. And I'm going to share this. John Novak dropped this in the room the other day, or yesterday, this morning. Sorry, it's Monday. And he did this because he is constantly barraged from people. John, I need your workspace. John, I need your trading plan. And for whatever reason, people think that they can bypass the learning process and go straight to the profits if they just do what someone else is doing. And in the end, this is John Novak's words, in the end you have to find a chart that you feel good about and you can be consistent with. And do not have anything else. Nexgen works on every chart, every market, every time frame. There is no such thing as best. It's what's best for you and your psyche, what you can be consistent with. And that is the search for most. And why trade like someone else unless you are that someone else? Just find your charts and your style within the teachings of chart reading and indicator reading that we give you. And that's exactly what it is, guys. And I put underneath that, everyone thinks there's something about traders. They believe that if they just had Mario Andretti's car, they would be able to drive like Mario Andretti. And if I just had Tiger Woods' driver, I could probably drive like Tiger Woods. And the reality is, guys, is that there's work that goes into it and finding your style and your groove. And this class is designed to be a foundation to teach you to read those indicators. So there's a step-by-step path to becoming a confident trader, and everything starts with just learning the rules. Learn the trigger line and the Fibonacci rules for when it's okay to trade. Embrace those first 2 advantages, and it'll open all the doors for you. Simulate, practice, guys, practice. And post the pictures in the room, and that's the first part of getting to where you want to be. Post in the room and talk about what you see. Hey, Mark, here's my chart read. This is where I entered. This is where I exited. Did I do it right? Feedback is one of the most valuable tools that new users, demo users, experienced users get. I will look at your charts, we'll talk about your read, and if there's a way to do it better, we'll discuss it. And if you did it perfect, we'll high five, and I love that. And I'll probably steal your picture and put it in my study materials. But the goal is that you're not practicing the wrong trades. It's fun to get paid, but it's dangerous to get paid through luck, guys. Rules are patterns that have been proven to win more than they lose, and that's where the consistency comes in. Practicing the correct trades. And you will make mistakes in the beginning. That's okay. How could you not? You're brand new. But put it in the room so that we can talk about it. We're going to simplify. We're going to focus on that high probability trend trade, and then very much that's going to take you to the next level. I'm going to introduce you to a second trade. It's what we call a medium probability trade. And a medium probability trade means that most of your indicators line up for a trade, not all of them. However, a small issue exists. Your ability to read charts will define that issue, and you have to typically manage these a little more aggressively. Your ability to read charts will allow you to manage them more aggressively. And very often on these medium probability trades, you're taking quicker profits, you're getting to a 0 loss level, Your ability to read charts, you guessed it, is going to put you in a position to be able to do that. But you've got to know what looks you're going to commit to, guys, and you've got to learn them so that they become easy. Recognition comes through repetition, taking pictures, annotating charts, putting them in and getting feedback, guys, and then using a spreadsheet. Nexgen gives you one, and this is your study guide or your trade journal, really, kind of both. And it's got 4 tabs. I just dropped my copy in the room for you. The first tab is where you're going to put every trade that you take. Every time you pull the trigger, it goes on this first tab. There are instructions on how to paste your pictures into the tab. And guys, there's even instructions on how to annotate your charts to get good fast. I want to share this. One of our users was nice enough to share it with us. And every time she posts, she talks about the 3 rules. She talks exactly, uses the language that makes the rules true. And every time she takes a picture, what she's doing is she's reinforcing these advantages. She's talking about her chart read, and then she submits it in the room to make sure that she's reading correctly. And guys, that's exactly what I want you guys to do. I want you to open up the conversation between the 2 of us so that we can get you where you want to be. The second tab on the spreadsheet is the 101 tab. This is the 3 rules for the high probability trend trade. Each and every one of them is in green, guys. I've broken down the rules individually, and I have given you a metric crapload of pictures that are annotated describing the advantages. I'm going to give you a sheet that puts you to work, that makes you take these same pictures and add to the spreadsheet so that you can create that recognition. And then I think the most important part of this one is what it looks like when the rules are not met. What it looks like when you would be breaking your rules, so that you can focus on always embracing those advantages. There's a favorite looks section where you guys will be able to build your own trading plan. As you learn to read your indicators, when you begin to understand these advantages, you're going to find entries outside of the high probability trend trade. This is a great place for you to work on those trades, to put them in, to commit those looks to memory, as well as management. You're going to see patterns that repeat themselves. Once you can read your indicators, you're going to begin to recognize patterns you didn't know you were looking for. There's a whole section on termination conditions. And then on the client trades tab, this is where I've done the work that you're expected to do to get to where you want to be. Sorry guys, $1 million jobs take a little bit of effort. I've got almost 400 pictures in the green section of you guys doing great things with this software. When we talk about the high probability trend trade, I've got that very mechanical entry, short and long, as well as management for the brand new user to take a lot of the stress out for you. There's ideas on when you can hold for bigger moves, stop placement, a lot on patterns that repeat themselves, and then a whole section dedicated to termination conditions. Rule number 2, because that is actually the most broken rule for new users. So there's an easy way to get to where you want to be, and it revolves around simplicity, and I can't stress that enough, guys. Don't overthink anything in the beginning. You've got plenty of time to make it complicated, but if you really want to get to where you want to be the fastest, let's focus on momentum through rule number 1, making sure we have strong trigger lines, and let's focus on making sure that there's nothing in the way, because once you do that, you'll be absolutely floored at the opportunities that present themselves in the market. So first hour is very much a lecture, guys. Second and third hours are nothing but feedback. So if you have questions during the rules, please post them in the room. I'll cover them. If you're trading while I cover these rules, post your pictures in the room, and then the second and third hour I go through all your pictures. So to define strong trigger lines on the large chart, guys, if the background is green, if the trend is up, strong trigger lines means that your small triggers, these solid lines, and your large triggers, these dashed lines, are both green as well. They're both angled in the direction of the trend. And then your small triggers break above and away from the large triggers. The large triggers need to be wide, angled in the direction of the trend. Guys, it's the space that's created between small and large that let me know that the odds are favorable for the market to continue up. In a downtrend, small triggers below the large triggers. Both are wide. They're angled in the direction of the trend. The space between the two lets me know that the odds are favorable for the market to continue down. And guys, odds favorable momentum. I want you to see this. Separation means strength. Separation means strength. And guys, it really is that simple. Even in a market that can't pick a direction, there are bursts of momentum going both directions. And the look is consistent on every chart. Whether it's a large chart or a small chart, a range chart, a month chart, a year chart, a tick chart. Guys, momentum is momentum is momentum. Separation between the small and large. And when the smalls return to the large, when they work their way back inside of those large triggers, that is weakness. We call this a weakening of the large triggers. And when I have weak large triggers, guys, anything can happen up or down. I'm a big fan of language, and I think that the language that you use is gonna accelerate the learning process. If you go back and take pictures of strong triggers and you use those words, strength, odds favorable momentum, and you take pictures of weak triggers and you use those words, weakness, anything can happen. What's going to happen is when you look at a large chart, you're going to say to yourself, well, with weakness, I'm not really looking for that next short trade. And this is just a bunch of lines holding right now. But you can see how strength carries you all the way to the key areas. And strength can push you up right into those key areas, and strength can carry you all the way to those key areas. And this is a great tool because these great areas, these areas turn into profit targets. And we rely on that strength to get us there. So guys, this is rule number one. Odds favorable momentum. You're going to hear that in the classroom all day long. Is everybody good with that? Can you give me a Y in the room if that makes sense? Separation means strength, guys. When you have separation, the market is likely to continue in the direction of the trend. Guys, it's this look that can break those key Fibonacci areas, and it's even this look that can cover a lot of the mistakes that we tend to make as new users. But when I have strength, guys, I'm going to buy Fibonacci support on a smaller, faster chart. I'm going to sell Fibonacci resistance on a smaller, faster chart. And you're going to see it on the slow-moving chart. It looks like these bars are sprouting tails. That's that pullback on a smaller chart. You're going to be able to pinpoint exactly where these tails are most likely to form. And then once you have momentum, you are halfway to the promised land, guys. Now we got to make sure there's nothing in the way. Termination conditions are they're Fibonacci-based indicators that can stop the market, that may stop the market, that may impede forward progress, guys. And when they're not present, you're going to have room to your profit targets. Pete says that crude oil looks like crap. I love it. That's a technical term that we use in the room. What Pete means, and guys, this is the lesson we're about to take, is that rule number 2 is keeping him out of trades. These key Fibonacci areas are taking away his advantage, and he's choosing not to trade without the advantage of a clear path. And that's exactly what we're going to do right now, guys. We want room to those profit targets. We want that clear path, because when you couple it with momentum, it's hard to stop that market. Areas that may stop the market, guys, may create an untradeable bounce. Areas that might reverse the market are horizontal lines on your large chart. Divergence highs, divergence lows. These are just magenta and cyan lines. They're going to print off of a pivot. And all this tells me is that there was a loss of momentum right at this pivot. Fibonacci resistance, Fibonacci support, these yellow 1-to-1s. All of these can stop a market, guys. And you're going to use the trigger lines to determine whether or not they're likely to, whether or not they have the potential to break, or whether or not they've broken. But understand exactly which lines are problematic, so that when price reaches those lines, when the large crowd makes decisions at these lines, you know exactly what you're in for, whether or not you have the advantage of a clear path or not. So to define a termination condition, the first thing that happens is price must reach that line, because these lines are where the large crowd are making decisions. These are where the sellers are selling, and where the buyers are buying, and where profits are being taken, guys, and where fights are happening. So price reaches Fibonacci resistance. It could be a divergence high. It could be yellow 1-to-1s. It could be that red line. When price reaches resistance, all you have to do is ask yourself, where are my triggers? And if they remain below resistance, it's a termination condition. It may reverse the market. If it does reverse the market, we're going to call it a strong top. Price comes down, reaches Fibonacci support. All you have to do is ask yourself, where are my triggers? If the triggers remain above support, support may reverse the market. There may be an untradeable bounce. If it does reverse the market, we'll call it a strong bottom, guys. Rule number 2 says don't trade into areas if the triggers are below resistance or above support. And guys, that is the most basic form of rule number 2. If price reaches resistance and the triggers remain below, don't go long into resistance, even with odds favorable momentum. And then if price reaches support, oh my gosh, how powerful is rule number 2? Guys, I'm not even taking a trade, but I'm starting to develop a little bit of trust here. All of these yellow boxes are perfect examples of price reaching an area and the triggers remaining below or above the area. Does everybody see it? Can you give me a Y in the room, please? This is rule number 2. Rule number 2 is going to keep you out of a lot of shenanigans. But one of the things rule number 2 does is it demands patience, because areas break and areas hold. And you never know what it's going to be. This is showing you what it's like when it has the potential to hold. In areas considered broken, you have to get both the small and the large triggers to the other side of that line. So price reaches, triggers are above, let's sit on our hands. And the path isn't clear until both the small and the large get below support or above resistance. When this happens, you have a clear path. There's nothing in the way. There's going to be room to your targets. And your path will remain clear until you reach the next line. And then you're going to go through that process all over again. Price reached the next line. Where are my triggers? They're below. Dang it, no long trades. No short trades, guys. Rule number 2 is going to keep you patient. But rule number 2 is going to keep you out of that potential fight right at a key area. So those are your 2 options as a brand new user, guys. If it reaches the area and the triggers remain below, the path isn't clear, the area is not broken, rule number 2 is not met, let's sit on our hands and do nothing, because really your investment is worth having these advantages. If the small and the large get above resistance, the path is clear. The path remains clear until you reach that next area. Even with odds favorable momentum, there's one of those tails in the clear path. That's going to become your entry. And then the second trade that you're going to put into your plan is what we call a 50-50 trade, guys. And it means that 50% of your triggers, the small, have smashed through that area with odds favorable momentum. Strong triggers can break areas, but your large triggers are still lagging behind. And what this tells me is that 69.80 has the potential to break. But because it isn't broken, I can't consider it to be a clear path. And if it's not a clear path, I can't consider it to be a high probability trend trade, guys. This will be your first medium probability trade. And if the advantage of a clear path is gone, you're going to be given a plan that has you focused on maintaining the momentum and making sure that the entry area is solid. So brand new users, let it be simple. It's either broken or it's not. And then from there, you'll begin to see these potential to breaks. That one had the potential to break, but it didn't. This one had the potential to break, but it didn't. So I'm going to give you a plan that helps you know when you still have the advantages to take that one. Support holds, resistance hold, potential to break, but doesn't. Everybody good? 2 of you are. Richard and Jeffrey are responding. Guys, rule number 2 is going to piss you off some days. I'm just going to say it. And there's going to be times when your path isn't clear because these areas are stacked. You might have support, under support, under support. And you're going to have to say to yourself, man, the path just won't clear. Even with that momentum, dagnabbit, I'm not getting paid. Guys, this is 90% of your day. 90% of your day is not doing a darn thing. 90% of your day is waiting for advantages. 90% of your day is saying to yourself, my investment in this market, my investment, this is my job, and my job is worth having advantages, guys. The futures markets trade billions of dollars every day. Billions. All you have to capture is 400 a day to put you in six figures. How cool is that? They trade billions, you need 400. Guys, that's not bad. And rule number 2 allows you to see where the driving forces of the market, the men and women who create trends and establish momentum, the men and women who react at these key areas. You know exactly where it's most likely to happen. And now you have a solid plan to make sure you don't get caught in their decision-making process, guys. And rule number 2 can keep you out of consolidation. It can keep you out of chop. And I think that's what Pete was just saying. Guys, look how clear that range is defined. You know exactly where they need to break out of to have a shot, right? What an amazing gift. How many traders are losing money hoping the market goes up? Those guys that say, oh, look, we made it just above the pivot. Let me go long. Damn it, I just lost again. You guys have like these x-ray eyes going into what the market is doing. Learn them, respect them, because once you have momentum and once you have a clear path, guys, the sky is the limit. There are so many ways to make money with this software. You just have to find the one that's best for you. But these 2 lessons will stick with you on pretty much every trade. So when they're met, when the large chart has momentum and when the large chart has a clear path, we're going to turn our attention to that smaller, faster chart, that refinement chart. We're going to say to ourselves, let's find an entry. Let's pinpoint where the market is most likely to continue. If you go to look for that entry and you see 3 divergences in the same price range, 3 cyan lines from a low coming off of those pivots, 3 magenta lines from a high coming off of those pivots. Guys, 3 divergences in the same price range may terminate the trend. This is true on any time frame, but you will see it first on that smaller, faster chart. So if I'm looking for an entry and I see 3 divergences, this is the only time where my room to profit targets isn't true, guys. The only time where the small chart will provide a termination condition. Otherwise, it is 100% large chart. Momentum and path are defined on the large chart. The only time the small chart's going to mess with me, keep me out of that high probability trend trade, is if I get 3 divergences in the same price range. But if my advantages are met, if those divergences aren't there, guys, I'm going to use a limit order to buy or sell a pullback in an area inside of triggers. I'm going to use a limit order. That means I'm actually going to wait for the market to come to me. I'm going to pick my price. I'm going to call my shots, guys. That's the precision that rule number 3 offers. And I'm going to do it at a line on the small chart. Fibs, mid-bands, and yellow 1-to-1s. Not pink 1-to-1s, not divergence highs or lows, guys. Fibs, mid-bands, yellow 1-to-1s. And I'm going to insist that they're inside of triggers. And as a brand new user, the easiest entry to find, the lowest risk entry to find, the highest probability entry to find is when those areas are inside of what we call favorable large triggers. And this is where I give the lesson, price returns to large triggers. Whether it's a large chart or a small chart, price returns to large triggers. It's a moving average. It's called a correction of the mean or something like that, something mathy like that. But if I have large triggers, price tends to come back to them. So what we've done is we've taken the large triggers from the large chart and superimposed them on the small chart. So now you have 2 sets of large triggers on your small chart, large and synthetics. The synthetic are from the big chart. When they overlap, when they're one on top of the other, when they look like 2 snakes riding piggyback, this is what we call favorable large triggers, because we've taken 2 correction points, one from the small chart and one from the large chart, and they are running one on top of the other to create one place where I expect these price bars to return. And then when we put a line inside of there, fibs, mid-bands, yellow 1-to-1s, we give the market something to bounce off of. So I expect price to come back to the large triggers. The small chart price may retrace back to the large triggers. And then I have 1-to-1s and a fib inside of there, and these may create the bounce. I don't anticipate the triggers creating the bounce, rather the lines inside. My synthetics, my large chart may retrace back to these triggers. I have a mid band inside. That may produce a bounce. So price may return anywhere from the top of this trigger line to the bottom of the trigger line. My area for entry is going to come from one of the areas inside. So I've got 1-to-1s, I've got fibs, I've got a mid band. This red box is exactly where I anticipate the bounce, guys. The window of opportunity. This is where I expect the failure from the small crowd. This is where I expect the continuation with the trend, with the momentum, with the clear path. So you've got to just work on finding that window. And that's what the first hour is dedicated to, guys. We haven't talked about making money. We haven't talked about managing trades. We haven't talked about anything other than recognizing advantages. And there's a reason for that, because it's the advantages that create the trades. So when the large chart says up, I'm going to take a picture of this picture. We're going to walk through it. And then quick thanks to Hong, because it was her question that created this lesson. Large chart says odds favorable momentum. Large chart has a clear path, guys. The first two advantages there, the rules are met. On the small chart, price is going to be screaming north, and you're going to start to get that fear of missing out. We wait for the reversal bar. The reversal bar signals the beginning of the pullback. This is that fight from the small crowd, guys. The reversal bar is not your entry, but at the time of the reversal bar, you're going to find those trigger lines, large and synthetic. Put a box around them, put a circle around them, mentally or otherwise. And this is where I expect the price bars to return. So I'm going to make this one yellow. These triggers are where I expect price bars to return. And now I'm going to look inside of them. Fibs, mid bands, yellow, 1-to-1s. And I'm going to create a window of opportunity, because price may bounce off of one of these areas, which means that price may return to the triggers and then bounce off of a mid band. These should be a different color. But I think this is such a cool way to create expectations. Price returns to the triggers, but I expect to bounce off the mid band. Price could also return to the triggers and potentially bounce off the 1-to-1s. So it's a window, and I don't know where it's going to come from. But because the large chart has odds favorable momentum, because the large chart has absolutely nothing in the way, your entry is from a limit order, a couple ticks above that highest point of support, the top of that window. And this is where you're going to enter your highest probability trend trade, with the full understanding that it may blow right past your entry and hit the next area and potentially bounce. But what happens is any line on the wrong side of the triggers, and when I say the wrong side of the triggers, anything below the bottom of the triggers is not where we want the market to go. And very often, if it goes below those triggers, this is going to be one of those 20 to 30% that don't work out, guys. So your entry becomes a pullback at an area inside of favorable large triggers. And we always go from the highest point, because the large chart has momentum and nothing in the way. If a divergence prints, doesn't scare me. It takes 3 divergences to keep me out of a high probability trend trade. And guys, this is the long entry. The short entry is exactly the same, but the other direction. The reversal bar signals the beginning of the pullback. The reversal bar is not the entry. Find your triggers, large and synthetic. They should be one on top of the other. This is the best of the best, the easiest. And then look for the line inside. There is one line, one mid-band inside of favorable large triggers. Your limit order goes a couple ticks below it, guys, and this is your entry. Divergence doesn't faze me. Small triggers turning against me doesn't worry me. The large chart has defined the momentum for me. This is my entry. Anything on the wrong side of the triggers is not a part of the equation. It's not in the window. It's not where I want the market to go if this is going to be a successful trade. So guys, what we're doing is we're defining where the market is most likely to continue. This should be your first couple weeks with me, being able to pinpoint this spot, because once you understand where the market is likely to continue, you know exactly where it shouldn't go. You use that language, area inside of favorable large triggers, to define your entry. Absolutely, I will. I was looking at them, and for a second, Hong, I thought that they might get a little confusing. So let's do the same thing. I love this drill, and you are amazing to me for having come up with this. The reversal bar says that the small crowd is fighting. I expect them to be able to push somewhere from the bottom of the triggers to the top of the triggers. So the pink line is where I expect price to go. Price may return on this path, that distance. And then I'll change colors. And I expect the area inside to be the spot where the bounce happens. And when there's only one area inside, guys, it's so easy. You only have one option for entry. Right there at that mid-band inside of favorable large triggers. So it may go up to the top of the triggers, but we really do expect that mid-band to be the place where it creates the bounce. But as long as it's inside of that correction point, guys, we're still in the trade. We're holding strong. Which is why pinpointing where the market is likely to go lets you know where to place that stop. John, absolutely. Areas are defined on the large chart. Areas are defined on the large chart. And here's a cool little thing. Why do we define areas on the large chart? Let's go to the fun facts. On your large chart, John, and this is such a good question, you're actually going to have your 5-1 Fibonacci lines superimposed on the large chart. You're going to have a 21-3 chart Fibonacci areas on your large chart. So you actually, on the large chart, John, have 3 time frames of Fibonacci, and each of them are equally important. But let me find this picture. Hold on just one second. And I'll show you why we use the 2 charts and why we let the large chart lead the way. Boom, 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 boom. There we go. On the large chart, I have one of those 50-50 looks, John. On the large chart, I have small triggers that have smashed through an area with odds favorable momentum. Because remember, the large chart's a different time frame. It's going to have a different look. These trigger lines are different moving averages. On the small chart, it looks like a termination condition, very much. And this line is what gives me the bounce back to my entry, because the large chart says this line has the potential to break because of the momentum. So we're going to let the large chart define the areas, John. Don't get beat up on the small chart, because a lot of times what you're going to see on the small chart is maybe a divergence, is the loss of momentum to get you back to the area. Maybe those 1-to-1s are exactly what we need to push us back to that perfect entry. So always let the large chart define the way, and let the small chart just be an entry chart. That's its role. It's just that refinement chart to get us in. Does that make sense? And it's hard. I spent a year letting the small chart talk me out of trades. And I'm not proud of that, but I'm very stubborn. And to be honest with you guys, I did everything but follow rules for the first year. I tried to create my own rules, my own reality. And that's why in the beginning I said, let the large chart do its job. Let the large chart define direction, momentum, and areas, and just use that small chart for entry, guys. Just let it pinpoint where the market is most likely to continue. It'll take so much stress out of your trading. It really will. And once you know where the market is most likely to continue, you know where it shouldn't go, guys. This is your first stop placement. Once you get to the wrong side of those triggers, typically 4 or 5 ticks above the trigger lines, this is where your first stop is placed, guys. And if they can push 3, John, it's imperative that you use the number 3 when you make that statement. Because 1 divergence, I couldn't care less. My large chart has odds favorable momentum. 3 divergences, may terminate the trend. That is the only time. It is rule number 2 not met on the small chart. Great questions, man. If this is where the market is most likely to continue, my stop goes where the market shouldn't go, 4 to 5 ticks beyond the triggers. Guys, it's okay to lose trades. It's okay to get your stop hit. Anything that wins 70 to 80% of the time, mathematically obligated to lose 20 to 30% of the time. But this is what I want you to do. If you lose a trade, I want you to be able to go back and say to yourself, I had momentum. There was in fact a clear path, and I took my entry right at the area inside of favorable large triggers. And what you've done is you've assured yourself that you have traded a pattern that has been proven to win more than it loses. And that occasional loser, guys, it's a cost of doing business. It's like paying rent on your storefront. And now I'm going to talk about another one. Is everybody good? And I know this is a lot in the very beginning, but all we've done is define entries, right? And we've given you the absolute best of the best possible scenario for those trigger lines. Guys, it's not always going to be perfect. And this is what you're going to realize, is the high probability trend trade as I teach it is a trade that typically shows up 3 to 5 times a day. That's it, 3 to 5. The 50-50 trade, that medium probability trade, shows up a lot. It really does. Favorable large triggers doesn't always happen. Very often what you're going to get are these split triggers, where the large and the synthetic are not quite one on top of the other. Maybe there's some distance between the two. But if you embrace the idea, and then Hong, I'm going to use your picture again, and I hope you don't mind me giving you credit for that, but I think it's brilliant. When this reversal bar prints, whoops. When this reversal bar prints, guys, price may come to these triggers. Price may also come to these triggers. Does that make sense? That's indecision. That's indecision. Price may bounce from this line. Price may bounce from this line. This is indecision, guys. There's a huge gap. And if your stop has to go below the lowest point of those triggers, that's an enormous amount of risk. Does this make sense, everybody? Understanding that price may correct to the trigger lines, understanding that it's the lines inside of the triggers that create the bounce. And then once you know that your stop has to go down here, that's a lot of risk if you enter at the mid band. Does that make sense? So there's a way, once you're comfortable with the idea that areas can create bounces, waiting for a reversal bar, a confirmation bar, guys. And this is one of the easiest ways to not get run over. When those trigger lines are split, when there's a lot of space between the triggers, when there's multiple areas, using a reversal bar for entry does not assure the win. It defines your risk, because once you get a reversal bar in the direction of the trend, your stop goes 2 ticks below it. And you can say, you know what? It may go down here, but they're saying we're going up. There's my risk. And you may have to take trades twice if you have 2 separate areas. Sometimes they'll go. Sometimes they'll stutter and come right back here and go. And then sometimes they'll stutter, come here, and then just stop us out. We never know. But this is one of the easiest ways to combat those split trigger lines, guys. So I added this into the lesson in the morning, because the reality is it's not going to be perfect every time. I'm giving you the best case scenario. I'm giving you the highest probability scenario. I'm giving you the foundational education so that you can grow from it and find your groove, guys. And remember when we said those tails are just the pullbacks? And Rob, this goes back to your question. Deciding if you have enough room, deciding if there's room to make money. When the reversal bar prints, the large chart is all the way up here, guys, at the top of this bar. That's the top, that's the beginning of the pullback. This is where price is trading. And from here to trouble, it's only 8 ticks. That's it. That's not a lot of money, guys. That's $80 worth of potential profit. Hopefully no one in here is risking $200 to make 80, right? Because that just doesn't make sense. But one of the great things that rule number 3 does for you is we're not trading from the top. We're trading from the pullback to support inside of favorable large triggers, which means suddenly that 8 ticks, what does that become? Stupid math. Turns into $310 worth of potential profit. This is why being patient pays dividends. This is why waiting for the payback or for the pullback creates dividends, guys. And a lot of the common things that I see, and John, it goes back to the question that you asked too. But Mark, there was a termination condition on the small chart. Guys, terminations happen on the large chart. But Mark, the small triggers turned against me. I lost momentum. Guys, look at the momentum on the large chart. It never even blinks during the pullback. Let the large chart do its job. If you go back historically and circle a tail on the large chart, it comes back to an area on a small chart. That's the perfect scenario. This is the look that you're committing to memory. Other things that new users do, and we've all done it. Don't act like you didn't. It doesn't quite hit our entry and starts to go up, and I see you guys jumping in at the top of this bar. Anyone other than me ever done that? I know that you have. Guys, your risk is still all the way down here. Your trouble is still right here. The only thing you do when you jump in, when you don't wait for that pullback, is you increase your risk and you decrease your profit potential. We're developing trust. This is your entry. If you wait 6 or 7 bars, your risk is bigger. If you jump in here on the reversal bar, your risk is huge. So guys, 20 days is what I say. 20 days. Learn how to study. 20 days. Commit the looks to memory. 20 days. Begin to believe in the idea that momentum and a clear path set the tone. And when you have it, gosh, the market's really been consolidating, hasn't it? Very often the market pulls back to areas inside of favorable large triggers. So let's look at this one right here. This one had the potential to break with that odds favorable momentum. If I circle the tail, what's it look like on a smaller chart? Right to the mid-band, and the triggers are split, which means there's a little indecision. Reversal bar for the entry, off to the races. Momentum for the win. And you can scroll back and you can study these over and over, guys. That one's into a termination. That's why the tail was so darn long. That one was much smaller, 1550. And it pulls right back to the mid-band, right inside of those triggers, guys. So this is your lesson. Define your entries. Learn how to read these advantages. Understand that that was never a clear path. And it blew right through everything. Rule number 2 for the win once again. So what I'm going to do now is I'm going to give you everything in my arsenal to make you successful. I promised it. Here it comes. Chart reading 101. Learning these patterns, guys, because in order to get to where you want to be, you're going to have to be able to recognize the looks and the patterns quickly because the market's moving. You're going to have to be able to open up your large chart and say instantly, I have momentum, I don't, and then commit to having that advantage. You're going to have to look at your large chart instantly and say, I've reached an area, the triggers are below, no trades into that area. Rule number 2 isn't met, guys. And the easiest way to do that, to become a chart reader, is to go back and take those pictures and fill up that 101 section. Take 25 pictures each. Strong triggers, weak triggers, know the difference. Clear path, termination, know the difference. And then be able to pinpoint your entries, guys. Whether it is favorable large triggers, the area is right inside, or whether it's one of those reversal bars confirming the move. Know exactly what it looks like and take pictures. But the key is don't just take the pictures, talk about the whys every time you annotate a chart. I'm just going to bring one up from the chart that I did. All green, smalls above the large with space between the two, strong triggers, odds favorable momentum. Guys, that's your look. That's what it's going to look like in the moment. That's strong triggers. That's strong triggers. But if you go through and you annotate it and you talk about the whys, What is the advantage? What rule does it pertain to? What's the look? What are the words associated? Guys, you're never going to take weak triggers into termination conditions because you're going to be speaking to yourself out loud, terrifying your pets. I have momentum. I have a clear path. I don't have momentum. There is no clear path. Therefore, I have no trade. So this is a drill, and I'm going to tell you right now, who's been with me for 30 days and hasn't done this and still isn't profitable every day or making mistakes? Don't answer it. Answer it in your head. People don't do this because it feels like work. It will take a little bit of work to get to where you want to be, guys. Next, I'm going to give you the high probability trend trade checklist sheet. This is nothing more than pictures of what it means to have the rules met. Is the market coming from a strong top or bottom? Not mandatory. You can take a trade without it, but you might have to look for those 3 divergences. If a termination reverses the market, you have a strong bottom. Same for a top. Do I have momentum? There's momentum. There's weakness. No reason to not be able to tell the difference between the two. That's a termination every time. There's the rules for it. That's a clear path every time. There's the rule for it. This will always be potential. This will never be a clear path, no matter how much you wish that it was. It won't be a clear path. Know the difference so you know what you're getting into, so you know how to manage your trades. And then there's your windows, there's your entry placement, there's your stop placement where the market shouldn't go. So guys, this is all available to police yourself as you learn these looks. Then the high probability trend trade is on the second sheet, guys, and this is nothing more than something to print out. And if you can mark yes to each and every one of these every time you take a trade, you have a trade that typically wins 70 to 80% of the time. I've never had anybody do worse than 70% taking just high probability trend trades. And again, this is your first trade. This isn't your only trade. For you guys using Market Replay, you can have this spreadsheet in front of you and pause the market to make sure that your rules are met. And if you do that for a couple days worth, you're going to see exactly how much potential there is in the market for you to do well. So I'm going to give you this one as well. And then I'm going to give you my baby, the KISS plan, the Keep It Simple Sunshine plan. Guys, this KISS plan is a disclaimer, is a stepping stone in your learning journey. That's all it is. The high probability trend trade is not your only trade, it's your first trade. And I don't anticipate anybody in this room to harness themselves to only a high probability trend trade. This plan is designed to optimize your chances of success, guys, to create that confidence, to learn to read your indicators through the high probability trend trade. But through simulation, through study, through class feedback, and continuous practice, you'll be empowered to craft a plan tailored to your personal goals, and it'll be based on your experience reading the indicators. Guys, that's just a clever way of saying once you can read your charts, you're going to see things. You're going to see patterns. You're going to see entries. You're going to begin to recognize management opportunities. But until you have that ability, the KISS plan is designed to optimize your chances of success. And your simple plan for consistency, don't fight the large chart. Guys, the people that move the market create the momentum on the large chart. The people that move the market react to the areas on the large chart. There's never any reason to fight it. It's not important. You can make all the money you could ever spend without ever fighting the large chart. And very often, fighting the large chart is a surefire way to commit financial suicide, guys. Fighting those strong triggers, trading into those termination conditions. This is my brother's best-selling book. It's 1 page long. So you have to define your entry. Why do we define the entry first? Well, because when you can define your entry, you understand termination conditions that reverse the market. You understand strong trigger lines. You understand what a termination condition is. And more importantly, you begin to use that language area inside of favorable large triggers to assure that you're getting into the market at the best of the best, lowest risk, highest profitability spot. And great entries create manageable trades. Great entries reduce risk. Great entries elevate profit potential. So we're only focused on entries. Guys, Simulator is designed for you to get the basics down. Get in at the right spot. And then once you're in at the right spot, that's when the fun starts. That's when things start puckering up on you, or you start putting pleats in your chair and your palms get sweaty because now you have something to lose. But if you get in at the area inside of favorable large triggers, if your stop is where the market shouldn't go, you have given yourself the highest chance for success. You've done everything that you can do. The only thing you'll ever be in control of is whether or not your rules are met. And one of two things are going to happen, guys. You're either going to get stopped out of this trade, 4 to 5 ticks beyond the triggers. It's a cost of doing business. Or you're going to get one of those reversal bars, that magical down bar that says, hey, guess what? We are going in the direction of the momentum. We have started off in the path where the path is clear, and you're going to move your stop 2 ticks above that reversal bar. And that's why if you wait for confirmation bars, your risk is established. 2 ticks above, 2 ticks below for a long. And there, once again, is nothing to do. This very mechanical management plan is designed to develop trust, to get you to the point to where you have rules for exit. You are either going to get stopped out for a smaller loss, or it's going to go to your first target. This KISS plan, and you know, it aggravates a lot of people because the target is so small. This KISS plan is designed to create confidence. And this KISS plan, more importantly, and I think this is an important phrase, is designed to teach you how to get paid. It is teaching you that when you exit a contract at a profit level, that money goes into your account, guys, and getting paid is the goal. So your first target's $100 away from your entry. And I'm telling you right now, with momentum and a clear path, it's difficult not to hit this. You're going to move your stop to break even. You're going to have absolutely no risk on this trade. And you're going to have money in the bank. And this is going to create confidence. And this is going to create trust in the idea that the only reason you were willing to pull the trigger was because the large chart looked like this. Because you had the strongest triggers you could ever hope for. Because the path is clear. And that break-even stop, probably not your best stop. But it's going to make it easier for you to hold for the second target. And the second target is $200 away from your entry. And if it hits your second target, guys, that's a $300 trade. That's $300 in your pocket. That is $300 worth of confidence. And that's you getting paid, getting out of the market and not worrying about what happens next. And then once again, there's that magical phrase, guys. You'll craft a plan tailored to your personal goals based on your experience reading the indicators. You'll begin to understand when you should be holding longer. Is this a strong bottom? All triggers turn. Nope. So Hong, for the brand new user, which you qualify as, we're going to keep strong tops and bottoms super, super simple. And let me find it. I'm going to pull this up and I'm going to drop it in the room for you. Whoops, where'd that go? A strong top or bottom. It has to be a termination first, but we want it to be a termination where none of the triggers break through, Hong, because what that means is that the buyers were in control. They were pushing, everything set up, and the decision that was made right at this key area was so impactful by the sellers that the triggers couldn't break through. Because the triggers are that moving average. The moving average never gets above. And then when it reverses the market, when the large triggers roll, then it becomes a strong top. So the same is true at the bottom. First, it has to be a termination with absolutely no triggers through. And then once you have that, if it reverses the market, that's when we'll call it a strong top or bottom. So on your picture here, what we have is your small triggers really kind of smashed through. And this is almost one of those potential to break looks. So with the trigger lines through the fib, and since these pink 1-to-1s on the ES don't count, it's a reversal. It's odds favorable, but it's just not a strong bottom. And it doesn't mean that you can't look for that next trade. It just means you want to keep your guard up a little bit. Make sure those 3 divergences don't print. But the idea of a strong top or bottom, and first of all, does that make sense? Hopefully that makes sense. Cool. And the reason that strong top or bottom comes into play is you're going to need it for when you start taking those 50-50 trades. Because one of the things is that decision to reverse the market is so impactful. It's such a powerful indication of what is potentially coming, that in order to take one of those potential to break trades, the first rule is that it's coming from a strong top or bottom. That decisions were made right at that key area that turned everything on its head and went the other way. It's also going to be very dependent on odds favorable momentum, the lesson that you get from the high probability trend trade. And then guys, this is one of the biggest ones, and this is the second one. This is the second trade. Do you guys remember when I said that the 50-50 trade is only the potential to break? And since it's only the potential to break, we don't have a clear path. So in the KISS plan, divergence is one of the biggest killers of a 50-50 trade. Divergence is one of the biggest killers of a 50-50 trade. So it actually tells you, don't let there be divergence. And it reminds you, divergence means no trade. And it tells you again in management, if divergence prints, get out. So as you move into the 50-50 trade, ladies and gentlemen, and everyone in this room is going to take them, divergence is your first giant red flag to avoid the trade. And then you'll craft a plan tailored to your personal goals based on your experience reading the indicators. This may change. But for the 50-50, this is designed to optimize your chances of success. Yeah, John, so those pink 1-to-1s, I've taken them off of my charts, honestly. But what they are, and let me pull this back up. We'll go to the glossary of common terms. The small swing 1-to-1s. These are tiny little fluctuations. I mean, they're itty bitty. There's not a lot of movement that creates them, which means that a lot of them can be created. So on the S&P, on crude oil, on that 13.2 chart, just not letting them come into play. If you're trading the NASDAQ, those 1-to-1s become imperative on the large chart. But on the small chart, when I talk about areas that may stop the market, areas that are considered to be potential termination conditions, those pink 1-to-1s don't make the list. And honestly, on my own charts, I remove them. I don't even add them in. But in my NASDAQ trading, I keep them in play because it's such a volatile market with so many moves that they can be impactful on those higher time frames. Does that help? If you're one of those people that likes to look at a 21.3, I might leave them on a 21. But for the large charts, I do on crude oil and the S&P. Not everybody shares my philosophy on that. I don't think so. Rules come from patterns. Rules come from looking at the same thing over and over and over. And rules that keep us out of trades means that when the market hit these pink 1-to-1s, 60 out of 100 times there was a reversal, right? And John, that's just not true for them. And Hong, that's them right there. These are small swing, and here they happen to do it. But they don't do it so often that they work their way into the termination conditions. Not the way fibs or 1-to-1s or divergence highs and lows have. So you'll see these. Nope. So in order for it to be a divergence, great question, Hong. Divergence is a pink line that comes off of a pivot. And you'll notice the white number and that pink line. These pink 1-to-1s will seemingly start from the middle of nowhere, and they may end in the middle of nowhere. And these pink 1-to-1s are a calculation. The market went down and up, and your software calculated the distance from this pivot to there. And it's the same as this. But there's so many of these instances that these pink 1-to-1s don't hold a lot of weight. So if you see the negative number, it's divergence. If there's no negative number, it's those pink 1-to-1s. Does that make sense? Cool. So guys, this KISS plan, I've had people follow this to the letter in their first 30 days with Nexgen and get funding in those prop firms. I've had brand new users follow it to the letter and do around 82-83% winners. I don't tell you guys how to trade. I will never tell you how to trade. But one of the things that I like to tell people that have been around a while is that if you're not hitting your goals every day, if you're struggling to make the money you think you should be making with the software, if you are trying to catch all the moves instead of the best moves, this KISS plan has proven to be an awesome way to kind of reel yourself in and refocus. And I developed this KISS plan from a conversation with a gentleman that was trying to catch all the trades, and the only thing he was catching was losers because he had so many trades that he couldn't keep the rules in line, and he started confusing the rules. And one of the things that you have to know before you ever go live, and that's what I put there, before you ever go live, because on simulator, break everything. But once you think it's time to get off of that simulator, you have to know why you'll enter the trade. You have to know what the rules are. You have to know exactly what it looks like, and you have to have a willingness to follow it. And then that's the easy part. I really think it is. Most people can find entries in their first week or two. But then you've got to manage it. Why will I exit the trade? What's it going to take to get me out of that great entry? And guys, commit to having the rules met. This is the greatest lesson that I've ever gotten from experienced traders. Have a plan and commit to following it. Because the rules are patterns. The rules are based on patterns that have been proven through back testing. Not just your back testing, but Nexgen's been doing this for almost 28 years. And the rules have been proven to win more than they lose, guys. And the more consistent in action you become, the more consistent in profits you'll likely become. So your process yields the results, and rules help remove the emotions. Ed, you're absolutely right. The exits are the most difficult part because, guys, there's two things that happen when you take a trade. There is, and I call it the what if monster, Ed, and I don't know if you've been in here for it. One thing that happens is you take the wrong trade, right? You break your rules, and that little monster on your shoulder says, but what if this one wins anyway? What if that termination breaks? What if those weak triggers push the market? Ed, don't get out of this trade, man. You're going to be so mad if that happens. And we've all done it, and we hold on to the wrong trade, and we hold on for losers. And then there's the other what if monster. Good morning, Miss Cindy. Where you are in the perfect trade. Happy Monday to you. Right? And Ed, let me know if this sounds familiar. You're in the perfect trade from the perfect spot with every advantage. And right about here, the what if monster says, but Ed, what if all that momentum, what if that clear path, what if that perfect entry fails? Dude, move your stop, tighten it up. You don't want to lose. Don't put it where the market shouldn't go. Put it where it makes you feel better. And sure enough, it takes you right out and runs, right? I see it all the time, guys. So what the KISS plan does for you and what this idea of exit conditions do for you is if you're in a high probability trend trade, if you're struggling with exits, if you're struggling with management, start with the KISS plan. That's it. So Ed, one of the biggest things that when I tell people send me your trading plan, they send me my entry plan, the KISS plan. They go, well, this is my trading plan. And when you ask them, how are you going to manage it? Well, I don't know. I don't know what it takes to get me out. And guys, you have to have a plan. And if you don't, in the beginning, the KISS plan is designed to get you paid ASAFP and get you out of the market before bad things happen. Or at least go break even so bad things can't happen. And then once you get comfortable with that, right, Ed, once you get used to following a plan, once you say to yourself, this is exactly what it takes to get me out, and this is the only thing I'm going to adhere to because I have to learn to follow my rules, then you'll begin to notice things that may change it a little bit. And this is where the problems set in, guys, for you new users. Everybody in this room that's brand new is thinking about 2 charts, 3 rules. And you're trying to remember the stops and where to put them and when you go break even and all that good stuff. All while going through the emotion of taking a trade, the anxiety, the fear, the adrenaline of taking a trade. This is why taking pictures is more effective to learn than actually taking the trades. And then once you add the 50-50 trade, well, you've added a new set of rules and you've added a new set of exit conditions. And then if you start adding in that momentum trade, shit, that's even more rules with even different exit conditions. And then if you get into an HVA trade, egads and little fishes, guys, you're thinking about 50 different things and chances are you're going to confuse them. So keep it easy. And if you struggle with management, Ed, there's 2 things that you can do. The first thing is keep it simple. The second thing is every time you finish a trade, go and look at it. So you wanted to see the one that I took this morning. I take so many pictures. This is a trade that Ron C. was nice enough to teach me, guys. And I want you to see something. Odds favorable, momentum leads the way. And then I get the back of the bar beyond any problem area. And I do the same thing on the small chart. So Ed, this is a different style trade. This is a trade that's 100% based in momentum. Which means momentum rarely lasts forever. I took $125 in about 4 seconds on the NASDAQ. And because I know that this is a momentum trade, because I understand that momentum doesn't last forever, that's why I take it. Because look, it started right back up. And you have to understand, is this trade going to be a home run? Is it a base hit? But I will stand by my guns just till my dying breath. The goal of trading is to get paid, right, Ed? And if you're up $700 and you go down $500, shame at you. Shame on you. Just get paid. And this is one of the things that I tell people. This is one of the things that I tell everybody. Ed, you are so stinking good at this. If you study for a month and get good at these entries, there's always another trade. Guys, there is always another trade. There's always an opportunity to make money. Look at this, 50-50, divergence, it didn't work. Straight out of the KISS plan. Don't trade into support, straight out of the KISS plan. Don't trade into one-to-ones with the triggers below, straight out of the KISS plan. Guys, the S&P is putting on a show of exactly why rules are important. And they're stuck. Something's going on in the world, and they're stuck. The large crowds are fighting tooth and nail. And then Ron probably made a little money right there. With odds favorable, maybe not. Clear path, may not have had room. So patience, guys, 90%, right? And this is what I'm telling you. You will be so good at finding entries that you won't mind getting paid. You will have this idea. Yeah, I didn't think so. When I looked at it a little closer, you'll have this idea that I can find a trade. I can find advantages. I can find the money in this market. And you'll begin to believe, because as a brand new user, you think that the trade you're into right now is the last trade that you'll ever be in. It's your last opportunity to ever make money. The market is going to flatline and die, and the stock markets will close. The futures markets will cease to exist. So you have to make $1,000 on this trade right now, or your dog's going hungry tomorrow. It's just not true, guys. Billions of dollars a day is what the market trades. You need 400 to be in 6 figures, which gives me the last thing that I'm going to give you here. And I already dropped these in the room, guys. Daily goals. Ed, define your goals. Yeah, a lot of times. But Ed, rules eliminate emotion. And the more that you commit to your rules, guys, the less emotion there is. If I take the perfect long, Let me find a picture, right? If I get into this trade right here, Ed, I know exactly where I have to get in. My rules say this is my entry. And my rules say that my stop goes right here. And you'll get to a point when you trust your methodology, when you've done the study, when you've done the market replay, when you've seen the pattern enough, you'll probably say, they have to come get me. I'm not going to give up this position because I have too many advantages. You're focused on the process. And then once they give you the reversal bar, you're going to say, all right, I can reduce my risk, but I'm not going to touch that until maybe the first potential bounce point is reached. And then once you take the first profits, you might say, all right, I've got money in the bank. The goal is to get paid. It may run forever. It may turn against me. Hell, I'll never know, but I'm not willing to give it back at this point. It's gone too far into the move. It doesn't make sense to give up $300 or $400 when you are up 5 or 6, right? Get paid. So Ed, you have to have a plan. Everybody in the room, you have to have a plan. It takes 4 crappy, failed, stopped out at break even, high probability trend trades to make 6 figures a year, guys. 1 successful high probability trend trade a day puts you at 75,000. Base hits pay bills. Have you seen Moneyball, Ed, with Brad Pitt? Has anybody in the room, have you guys seen Moneyball with Brad Pitt? Yeah. What's the goal? When they build the team, what's the goal, guys? Do they want the home run hitter? Do they want the all-star shortstop? Get on base. Base hits. Day trading is a lot like Moneyball, guys. If you get on base 4 times, that's 6 figures. Let that sink in for a second. If I take this 1 4-second trade with success 4 times a day, 6 figures. Anybody in the room be mad about 6 figures? Of course not. And guys, all this is momentum and path. Momentum and path. The same things that I preach every day. 1, 2, 3, 4 divergences in the same price range, guys. Can we all agree that this is a market that has the potential to push down? That this is a market that maybe this area won't break? It might, but in the moment, our advantage is gone. And if you tried to take the long, you just got run over. Rules are designed to take the emotion out, to take the fear out, to take the guesswork out, guys. You either have the advantages or you don't. In the room, I dropped the exit conditions. I dropped the high probability trend trade checklist, the KISS plan. I dropped my PowerPoint in PDF form, chart reading 101, and daily goals. My promise to you guys each and every morning is that I will give you every tool that you need to be successful with the software. You now have that. You now have the rules. You have access to exactly what they look like and what the advantages mean to you. You have a plan that is designed to optimize your chances of success. You have a daily goal sheet that lets you know what you need to make every day to hit your goals. You have exit conditions that remind you that rules are imperative. The only thing that I haven't given anyone in this room is experience. I haven't given you the repetition that you need to make this easy. And that's where it's up to you. And I'm going to say it again. Taking trades, expecting to become a great trader through nothing but taking trades is just shooting yourself in the foot, guys. Take pictures, and I want you to see why. Because if all you do is take pictures a little bit, I'm going to use the shape. That's a term. That's a termination. That's a termination. That's a termination. This is a termination, guys. Without question. And now I know exactly what it looks like. This is only the potential to break. This is only the potential to break. I know exactly what it looks like. This is momentum. This is momentum. This is momentum. I'm never going to confuse it. Take pictures. Burn these into your brain. And be willing to sit on your hands for a little bit, guys. Because when the triggers weaken right at an area, the area is more likely to stop the market. When four divergences happen right at that key area, it's less likely to push up. There's a lot going on that isn't in favor of your trade. So that's my first hour. We made it an hour and a half. It's Monday. I want to make sure you guys get all these. The second half of the day, guys, is going to be answering questions and looking at pictures. But before we do that, I'm going to do my absolute favorite thing. I'm going to go stretch my legs, and I'm going to pet my dog, and I'm going to take a deep breath outside, and I'm going to get ready for the second half. I encourage you guys, get up and walk away from your computer every now and then. There's a gentleman that said he can't do more than 90 minutes. 90 minutes in front of the computer is too much. His brain starts to create trades that aren't there. So take a walk. I'll be back in 5 minutes, and we'll get into the second half of class, guys. If you have questions, post them. If you have pictures, post them. See you in a minute. All right, guys, we're going to get back at it here. So what I'm going to do is I'm going to scroll up to the very top of the chat box. We're going to start clicking on some pictures. There's not a lot today, I'm not going to lie. Market has been very consolidating. Guys, these are the days when you asking questions gives me a little job security. So don't be afraid to ask a million questions today. Jen says this is her 8 a.m. warm-up. She has a termination condition. No triggers through. It reverses the market. Strong top. Very nice. Odds favorable momentum. She's got smalls below the large are wide. They're angled in the direction of the trend. Life is good. She lets the back of the bar clear the fib. She lets it clear here. Gets in, gets out. Easy money. Nothing in the way. Sold at the yellow 1-to-1s on the large. Beautiful trade, Jen. Momentum and clear path for the win. And then the next one, all happening at 8 a.m. Not odds favorable momentum, but back of the bar clears. And guys, this is one of my favorite words when you annotate charts. Rules not met, but. And this is literally you telling yourself, hey, my rules probably weren't met, but this is why I'll take the trade. For the brand new user, that's a little problematic. For someone with experience, it's okay. Because what it means is that she says, this isn't the best of momentum, but let me go ahead and calculate the rest of the advantages that I see and see if I'm willing to still take the trade. And she was, because it was getting below all the areas, and she gets a perfect snapback right to the area, right inside of triggers, and she's able to run that trend down all the way to the fibs. Absolutely beautiful trade again, Jen. Nicely done. And then finally, waited for price to clear the divergence line. I love it. Back of the bar clears price, room to the trouble spot, and once again, easy money. As it was 8 a.m., warming up, only one contract, sold at trouble price, smashed through. If I had more contracts, would have held and had stopped just above the reversal bar marker. Beautiful trading, Jen. Guys, everything that she did there revolved around a clear path and then looking for her opportunity, which is pretty cool. Dun, dun, dun. Let's see what else we have. Ron, same concept. Odds favorable momentum, clears trouble. Ron, is the mid band not a part of the equation for you? Because you did trade into the mid band. Beautiful. Great looking trade. Not when it's that close. Fair enough. So if the mid band isn't behaving as a termination condition, you pull it out of the equation. Asking for a friend. Word up. Thanks, man. All right, Pete. Everything says down. You and Ron get the same entry. The difference is Pete is a huge fan of letting the large chart lead the way. Pete is notorious for letting the large chart lead the way. And when he's got this much momentum, he says, man, we might make a fib. And then he finally exits through a tighter stop because Pete knows that the goal is to get paid. Nice trade, Pete. And guys, these charts aren't high probability trend trades. Not one of them yet. But everybody in this room started learning through the high probability trend trade, through establishing the ability to understand momentum, to start seeing those paths and whether or not they're clear, and then just kind of finding a way to do it that suits their needs. And that's probably my favorite part about this classroom. Is you guys show me what can be done with this software that I don't even teach in the room. But you've got to get those basics first. One tick from each other. Something you notice, not sure if it's in the rules or not, but anytime I get two divergences in a downtrend, the smalls are above the large. It almost always blows right through the midband. That's probably a good observation. And this is patterns. And Pete, this is one of those things where I would go back and study it. Go find 100 pictures because, shoot, this may save you thousands of dollars over the next year. That's pretty cool. I haven't done a lot of study, but for me, once the smalls are on the wrong side of the large, because this is momentum, this is like anti-momentum at that point. That's pretty awesome. Good observation. No, and I get it. No, almost always, right? Just shy of always. I'm going to give you that one. That is accepted vernacular. One of those phrases you have to embrace when you're an English Lit student so you don't walk around being a pretentious ass correcting everybody. Accepted vernacular. All right, Rob. Because the market went down. There's your answer, Rob. Why are you getting stopped out? Because the market went down. So you had momentum, without a doubt. It even looks like you had a clear path. You get in above the triggers, right at the 1-to-1s. And it doesn't work. So Rob, did you have momentum? Give me a Y in the room. Did you have a clear path? You had a 50-50, right? It had the potential to break, but it wasn't quite broken. Did you enter at the area right at the triggers? I feel like you did. So Rob, the only lesson that you didn't take on this one, the only thing about this chart is that the bottom of the triggers are at 73.25, which means right around 71.75, 4 ticks below. Just, that's stop placement as taught in the KISS plan, 4 to 5 ticks below the triggers. Because what you've done is you said, well, shoot, I'll hide behind this blue line, right? You're 1 tick behind the blue line. Rob, just take your hickey. It's a great look. Big stops don't assure winners. All they do is create giant losses when it doesn't work. But what you did do is you took the correct trade. You took a great looking trade that didn't work. And you did a little self-sabotage by creating this fictitious idea that this will stop the market. So great trade. Tighten up that management a little bit if you feel like, if you're tired of taking these big losers. I love the look though. And you had no idea that the S&P was going to consolidate all this morning. You had no idea. But dude, it's a great looking trade. And your entry shows patience. So we're going to celebrate a lot on this one and then just look for that management opportunity. And now this one, you just jump in. All right, so next lesson. And Rob, one of the worst things you can do, I firmly believe this, stop filled again. Right? What are you saying? Boo freaking who, the market hates me. There's nothing to get out of stop filled again. Why don't we do this? Enter this trade based on the momentum of the market. When price closes on the wrong side of the small triggers, momentum is over. Why the hell am I giving up 8 points on a momentum-less momentum trade? So Rob, this goes back to, you have to understand what kind of trade you're in, right? And if you're just going to jump the fudge in, No areas inside of favorable large triggers, and you're in on the wrong side of the triggers, right? Your first option for a potential entry really isn't inside of triggers. Your second is inside, your third is inside. So you've got all this indecision. This is rule number 3. This is what I teach every morning. When the triggers are split, when the indecision is there, when you're just not sure where it's going to go from, force it to give you a reversal bar. I've started teaching that every morning. Right on. That I can't help with. If you're jumpy this morning, you know, but I really think that you're understanding momentum, right? And you're checking out the idea of path and feeling okay with it. And again, if you waited for a reversal bar on these, I could probably support you 100% on that trade and say, Rob, you gave it a good shot. But when it's not perfect, it's okay to demand a little bit of confirmation from the market. And it means that you're not going to get every trade that you want. Jen, odds favorable. You're 1 tick shy of the termination. Pulls right back to support. And you get out of trouble. Jen, I actually like this one. You've got a 50-50. Strong triggers. And the 1-to-1s weren't hit. And when I talk about fibs, a tick below, a tick above, I consider it hit. 1-to-1s are an exact mathematical equation. Divergence lines are an exact number. You didn't get there, and it's just a quick little pop with great momentum. That's heads up trading, taking advantage of quick little moves and your willingness to get paid in that tight area instead of hoping that it runs forever is pretty awesome. Andy, weak top. Look at that termination that rolls it. So divergence prints and you get in on the left side of the triggers and just hold it up. So termination, divergence, small triggers roll, and you decide to hope that it goes up, and it does. Taking advantage of termination conditions, Andy, pretty nice. Not a high probability trend trade, still fighting trend, but doing it with a pretty solid plan. Nicely done, man. Arnie, I'm loving Arnie's posts. Man, not a meh bottom. Arnie, that's the sexiest bottom ever. Don't tell my wife I said that. She's going to think I'm hitting on you. But, dude, this is 100%. Look at that termination condition. Not one trigger breaks through, and it reverses the market. That is an indication that the sellers not only failed and the buyers told them to go to hell. So this is a strong bottom. It's beautiful. Odds favorable momentum. It's beautiful. It's the potential to break on this divergence high. Large triggers aren't through, but from a strong bottom with this level of momentum, and look at your entry. Like a sniper, 2 ticks above that mid-band, virtually no risk, so easy to get paid all the way to trouble. Arnie, this is gorgeous. Everything about it, except for the bottom. It is a strong bottom. Does that make sense? He's probably in a trade, not even listening. So guys, this is one of those pictures that I would put in here because it's done really well. There's a lot of great lessons on here. Arnie's great 50-50 long, right? You're going in there. You are immortalized. And remember when I said that you'll craft a plan tailored to your personal goals based on your ability reading the indicators? For you guys that are brand new, this divergence keeps you out of this trade. For all the new users, 100% KISS plan, adamant on following rules, this divergence keeps you out of the trade. One of the things that a lot of you will do as you get a little time in the market is when you see a strong bottom, When you see that termination that reverses the market, guys, you might let it override one divergence. I know that I will. Two divergence is an absolute killer. But one coming from a strong bottom, especially with an entry like this, all day long, Arnie. What a great, great trade. All right, Miss Cindy. Didn't quite hit your termination, but everything rolled down. Actually, yeah, your termination's right here, though. There's your termination. Great patience, waiting for everything to roll. Great patience, waiting for everything to roll. It's a beautiful trade. This fib right here, looks like there was a fib update. Price reached it, triggers remain below. I guess technically it rolled it. You could call it a strong top, but it's definitely a no triggers through termination, Cindy. And that is the requirement for the white bar trade. So you did it perfect. Does that make sense? And I think my favorite thing about this trade is that instead of hoping it goes down from up here, everything rolled, like everything agreed on your smaller charts. Nicely done. And man, odds favorable, 50-50. You sold it at the mid-band between wide, ugly, large triggers. So no confirmation, just using the mid-band, hoping that it holds. And it went all the way up to the synthetics almost, so good stops keep you in place. But Andy says, man, from a strong top with this level of momentum, I'll take a shot. I'll take 4 off at $6.50 each, and then let the last one run. Nicely done. Getting paid. It's all about getting paid, right, Andy? $50 doesn't seem like a lot of money until you realize he did it on 4 contracts in a half a second. And then suddenly that's $200. And then another $225 all the way down there. Guys, this is like a $425 trade with a pretty ugly entry. Awesome. Goals met. Nap time. Long weekend. Right on. And guys, when the market consolidates, we just made it through all the pictures. Weakening triggers. You're welcome. All right. So Pete, there is small triggers above the large with divergence. This is Pete's case study. Pete says, Mark, this might be a pattern. What do you say we check it out? And to Pete, I say, let's do that. Let's study. But let's backtrack just a little bit. 1, 2, 3, 4 divergences. Large triggers don't break. And guys, look at that. Geronimo. That's what they used to say when they jump out of planes. Terminations, terminations. Gosh. S&B is in a giant fight today, guys. So this is where I ask you guys, what do you want to talk about? Let's just do a chart read. Very nice, Shadow. Do I have momentum on the large chart? Guys, this is where we're just testing your ability to read indicators. That's all we're doing. Do I have momentum on the large chart? Are those triggers strong? What do you think? If you're not sure, tell me you're not sure. And then let's turn that into a lesson on strong triggers. Because I'm about to have to talk for an hour and 20 minutes with no trade pictures in the room. What do you guys think? Nobody has a clue. Let's do awkward silence for a little bit then. How's that? Thank you. That's it, guys. Strong triggers. Do I have a clear path? John, perfect. No clear path. So what does that mean to me? Guys, if I'm following rules, it means no trade. That's it. It's that simple. Sit on hands. Wait. Strong bottom, clear path, smalls above large. Let me figure out where this was. Right over here. Pulls back to the area inside of triggers. Okay. Oh, Hong, you posted these on the weekend, didn't you? Sorry, we could go back and revisit these. I'll go back to them. I know where they're at. All right, so let's do this. Let me pull up my little picture taken thing here. There it is. All right. So, at the time of the reversal bar, there's the top of the triggers to the bottom of the triggers, right? So, Hong, I have this theory. If my reversal bar splits an area, right? So if the reversal bar gets below an area, closes below an area, that area is out of the equation. I don't consider that one of my areas for entry for the trend trade. So my window of opportunity will extend from the highest point of support to the lowest point of support inside a favorable large trigger. So with this look, Hong, your first entry would have been right here at 56. Does that make sense? Right on the top of those triggers. And your initial stop would have been about 4 ticks below. So about 4 points, 16 ticks. And then here's the cool thing, Hong, is with that KISS plan, you made $100 before it turned again. And you probably got stopped out break even right here. So if you did it KISS plan basic, you made $100 on this look. Not bad. Quick $100. And then this is where, as you mature a little bit, you'll realize that we're still inside of that correction point, right? The small chart could correct from here to here. The small chart, this is where we expect it to correct. And then there's some bouncy points for it if it's going to go up. So if you chose to enter back in at the area inside of triggers with this look, and the bottom was at 53, which means that your stop was probably right around 52-ish, give or take. You might have actually been in that second trade to run up with it. Does that make sense? So in the beginning, guys, a lot of you are going to take the first trade, maybe make $100, get stopped out, and not see the second trade because the adrenaline's going to be overwhelming from the first trade. So if you took the first trade home, probably $100 in break even. If you took the second trade, you probably made your 300. And then it just kept going and you were wondering why the heck you only took 300 on that trade. Does that make sense? It's a good picture. But where's the entry? At the area inside of favorable large triggers. And you don't have that until all the way up here. Does that make sense? Because a lot of times people see this and they say, Mark, where was my entry? Where do I get paid in this giant move? And the reality is there really wasn't one. But they came back for you. And then they continued with that trend. Guys, these are those fights that happen. We take advantage of that fight. Great picture, Hong. Good question. But this is where using the language, the area inside of favorable large triggers, you'll go from asking where your entry was to saying, hey, Mark, was this the right entry at the area inside of favorable large triggers? All right, learning to annotate. Is this correct? No clear path. Rule number 2, not Matt. We're approaching a midband that is starting to curve. I don't want you to worry about the midband, Hong, whether it's curving or not curving. So you had the termination. It reverses the market. You have odds favorable momentum. But here's the deal. And I put some cool pictures in here. The midband in this case is not a termination condition. And it's not a termination condition because the large triggers are not a full bar away. And this is the gap theory. And that's what I wrote in the room before. So if price comes up and reaches a magenta midband, if your large triggers remain below the reversal bar marker, the midband behaves as a termination condition. In your case, price comes down to the midband. If the large triggers remain above that reversal bar marker, well then the midband is behaving as a termination condition. So what we had in your picture is those large triggers were definitely not a full bar away. In your entry, there's the midband floating in between. Maybe you get in, and then it comes up and it stays in those synthetic triggers, and then it continues down. So this is one of those instances, and it opened up the door for a great lesson, guys. The midband is not a termination condition if the large triggers are not a full bar away. Does that make sense, everybody? And that's straight out of the termination condition section. Large chart midband if the large triggers are a full bar away. So let me give you guys these pictures. Drop them in your spreadsheet. Yeah, I'll be happy to, Gil. So when is the midband a termination? And this is where language is going to help. So Gil, the midband is a termination. Hold on, where's that? If the large triggers are a full bar away. Is everybody good on that? Let's just talk about that phrase right quick. The midband is a termination if the large triggers are a full bar away. Those are the rules. You're not okay with that, John? That's okay. Thank you for that. Oh, you are clear. No clear, not clear. Typing is tough sometimes. No worries. So check it out. Price reached the midband. Look how close. Just doesn't even come into play. Let me find one where it reached the midband and the large triggers were a full bar away. In a consolidating market, you don't see it so much. We had some perfect ones. There we go. There's a good example right there. So John, we're going to go through this bar by bar. Cool? You're going to like this. Market's going down, having fun, hits a term, starts back up. Price reaches the midband. You with me so far? Do I have to, is the midband a termination condition? This is the question, guys. Can I trade into this midband or is it a termination condition? Here's how you decide. So when the market's trending up and it hits that midband, John, if your large triggers remain below the reversal bar marker, if your large triggers are a full bar away, and that's what the reversal bar marker is. Maybe I should do that as well. What the heck's a reversal bar marker, Mark? Well, let me go to the instructions. The reversal bar marker tells you exactly where this bar will become a down bar. So I guess you have to know that. Reversal bar marker gives the exact price where this bar becomes a down bar. So if these triggers are below the reversal bar marker, John, it means that they are more than a full bar away. Does that make sense? Does that help? And I love it when you guys say no, because it means that I've got to find a different way to teach it. So same thing here. Price reaches the midband. See how the large triggers are above that reversal bar marker? There's room for an entire up bar before it hits those triggers. So absolutely no shorts into the midband. And that's exactly what happened here. And sometimes it'll go a little bit above it, sometimes it won't. But see how when that reversal bar prints, there's room for that whole bar? No trades into the mid-band. And the fact that there's a fib here, you're not going long anyway, right, John? But if this fib weren't here and it was just a mid-band floating out in the middle of nowhere, this would keep you patient. And that's called the gap theory. When price reaches any area and it accelerates away from those large triggers, a full bar or more, the gap theory says, well, price is likely to snap back like a slingshot and just choo. So whether it's a fib, whether it's a mid-band, fibs are terms anyway. But if it was just a mid-band, the same thing. So let me give you this picture too. And it acts like a vacuum. It sucks price right back to it. So I think that's all the pictures for those. And then if you want to study it a little more, because I'm an overachiever, here in the spreadsheet, you're going to find probably 25 to 30 pictures of the gap theory. Some of them presented by users, some of them just me from my own study. And initially the gap theory, initially the gap theory says, hey, don't take that long trade into the mid-band, right? Don't take that long trade into fibs. It's likely to pull back. And then you'll see people in this room that take that gap theory and look for an entry condition to close the gap back to those triggers. And that's a little more advanced. And it's a little higher risk because you will be fighting momentum and you will be fighting trends. So good stuff. A lot of those are here in the spreadsheet though. And I just dropped my spreadsheet in the room one time, again, just in case you haven't gotten it yet. Large triggers are not below the reversal bar marker. This isn't necessarily the gap theory, but it is very much a termination condition. You're welcome, John. I'm telling you guys, there's nothing off limits, and nobody has ever asked a bad question. Every question is a good question. Because if I say something and you don't understand it, guys, you gotta tell me. I can't see your faces. All right, Hong, here's one more. This is a divergence line. Yes, not a termination line. These are the same line, correct? So they're different lines. Let me scroll back to the bottom here just to make sure. Divergence lines on the large chart come from divergence on the large chart. So divergence lines on the large chart will print off of a pivot if there's a loss of momentum. Divergence lines on the small chart, you're going to see a lot more of them. Both are unique to the chart that they're on. Does that make sense so far, Hong? So if I have large chart divergence, like this is printing right here, it's not necessarily going to show up here. It happened to. But this divergence doesn't show up on my small chart here. So they're unique to the chart that they're on. And then it takes 3 divergences to kill the good time for a high probability trend trade. So they're just unique. And then Gil, what would be... Doesn't matter if the large triggers are at the mid-band or not, Gil. And guys, this is one of those things where repetition creates recognition. The large triggers at the mid-band has nothing to do with anything at all, really. Because the gap theory says that I have to reach a mid-band and the large triggers have to remain a full bar away. If they're right here, it's just insignificant. Does that make sense? It's this look. When price reaches the mid-band, where are the large triggers? Not when price is way away and they're together. And that's pretty common misunderstanding. Termination condition though, right, Gil? 100%? No clear path. Do you see it? That's what this picture says to me. Watch this. I'm going to use this picture as such a good picture. Price reaches resistance, triggers don't break. No long trades. Price reaches resistance, even with odds favorable momentum, triggers don't break, no long trades. Price reaches divergence low, no triggers break. Broken record that I am, no short trades. Price reaches Fibonacci support, none of the triggers break. You guessed it, no short trade. Pretty cool, right? It's a very simple recipe. This area, because the small triggers are through and the large triggers are not. This area is one of those potential to breaks. Potential to break. And guess what? It didn't break. So this is the one where I like to use the pause. Let me make sure that I'm not sacrificing momentum. Let me make sure that I've got a low enough risk to feel good about it. Does that make sense, Gil? But on this most current bar, you've got odds favorable momentum, yeah, and you got no clear path. And look what happened right off of it. And rule number 2, ladies and gentlemen, is defining the fight in this market today. And some days, the market is just not doing it, right? Termination, potential. So now we have the potential to break. I'm coming from a strong top. I have the potential to break. My rules say make sure there's no divergence. If I got a reversal bar right now, that represents the point where the market is most likely to continue. Somewhere from that lowest point of resistance to the highest point of resistance. But guys, in a market that's been consolidating all day, these 50-50 trades, they're either going to be the biggest winners ever or they're going to lose almost instantly. This is where the sellers attempted to break out of that range and the buyers stopped them cold. And this is where the buyers attempted to break out of that range and the sellers stopped them cold. So let's see what happens on this one. Divergence printed, which means that the KISS plan is not met. KISS plan rules are not in play. It might still go down, but we don't have the optimum scenario. And this is where you guys are like, oh, I should have taken it from resistance. Man, I would have been rich. And then they go, oh, wait a minute. Maybe we'll come up again. We'll see what happens. S&P is very fighty. Crude oil cranking to the downside. Been a day. Is there an election or something coming up? I don't know. All we can do is trade our patterns, guys. And they're either going to work or they're not. But they've been proven, if they're in your plan, to work more than they don't, right? So we just wait. So on the large chart right now, do I have strong triggers? Most current bar, guys, talk to me. Do I have odds favorable momentum? Do I have a market that's likely to continue in the direction of the trend? Are the smalls below the large? Is there space between the two? Is everything wide? Anybody? Guys, if you're just learning, answer it in the classroom is one of the best things you can do. Morgan, thank you. Because if you say yes, guess what? Then we get to have a lesson on momentum. There's just not the momentum there. That's it. That's where I stop. What do you guys want to talk about? That's it, Shadow Picks. And you know what stinks is I know some of you are on demo right now. And you demo guys are going, well, hell, there's no trades today. So there's no way I could possibly make money long term with this software because today In the last 2 hours, there hasn't been a trade, right? Guys, this is where I encourage you to kind of focus on what you're seeing other people post in the room as well. Because while you may not see it, not just yet, the people that have put the time in are getting paid today, right? The people that have rules are finding a way to make money based on momentum, based on termination conditions, based on those paths. So a lot of you guys that are on demo right now, I want you to remember that every day isn't just an ATM big Vegas win. Some days are freaking amazing. Some days really test your patience. Uh-oh. You can scroll back, Shadow Picks, and just take it again. Absolutely, Arnie. No such thing as an okay bottom. Let me go through C-Dub's picture, and then that's exactly what we'll do. Thank you. So you see the second trade is an easy trade, but the first one into the 5-1 ones to ones. You know what's funny, C-Dub, is that you think that these little 1-to-1s are the problem. And you don't say anything about odds favorable momentum against the trade. All you know is that the market went up, and how do I get paid, right? That's the easy one. I agree 100%. Why come? Why is odds favorable momentum down bad? You're right. Number 2. Do you need number 1 hoping it works when number 2 says it's going to be almost impossible for it to not work? Does that make sense? So C-Dub, one of the biggest things that we all have to do is we have to say to ourselves, this kind of sucks. Let me give it a minute and see if it gives me a better entry. It might go from here, but with odds favorable momentum, everything down, isn't that 1-to-1 right inside of the synthetics? Isn't that a potential spot for more down with this look? Does that make sense, C-Dub? Odds favorable, potential to break. Hell, that represents an area right at the triggers, almost like an entry for a short. 2 divergences say the 50-50 is less likely to work, but once you get above that stuff, man, easy, easy. Good picture. All right, so Arnie, look at, I'm going to get out of this. You're welcome, C-Dub. I'm going to go back a little bit, guys. Just into a market that's not really consolidating. So Arnie, I want to keep it simple, okay? 2 words to describe tops and bottoms. Strong and weak. Are we cool with that? Let's not do best of the best, good, okay, meh. Let's keep it super basic. It's either a strong top or bottom or it is not. Those are the only options. Because think about it. If you have a rule that requires, that's it, strong and weak. If you have a rule that requires a strong top, why confuse yourself with all the other stuff? Why give yourself a million options that don't find their way into the rules? So check it out. Price reaches Fibonacci support. None of the triggers break. And this is one of the key things for strong tops or bottoms is I hope this makes sense. A no triggers through the area termination. Is everybody with me on that? No triggers through the area termination. So this is a term. Everybody good with that? Arnie, you cool? This is just a termination, right? That's all it is right now. When the large triggers roll, right there. Now it's a strong bottom. So that's the recipe. First it has to be a termination, and then it rolls the market. So by that reasoning, Whoops. Dun, dun, dun. We'll do the lows first. Maybe. Goodness gracious, get off of there. There we go. What do you think? Arnie, strong or weak? It broke this one, and it didn't make it to the one-to-ones. So what do you think? Strong or weak? Perfect. Large couldn't make it through. Smalls couldn't make it through. Strong or weak? Strong. Hell yeah. Smalls couldn't make it through. Large couldn't make it through. Strong or weak? Play along, everybody. This is fun. Strong. Reach the mid-band. Reverse the market. No such thing as stronger than another, Arnie. Anytime a key Fibonacci area stops the market, that's kick-ass. When it reverses the market, holy crap, right? So what do you think about this one, Arnie? Price reaches the mid-band and the large triggers remain a full bar away. Isn't that a termination condition? You guys remember the gap theory from just a little bit ago? Price reaches the mid-band. Large triggers are a full bar away. That's a termination, isn't it? Can you give me a yes or a no if that makes sense? And guys, this is the one that people forget. So this termination reversed the market. Is it strong or weak? Perfect. Absolutely perfect. All right. See if I can throw you guys here, because you know that's what I do. Is that a strong or a weak top? Go through the language. Wayne says it's a strong. But Wayne, your small triggers made it through the fib. Steve Diego says strong. So guys, where did the reversal happen? Off of that. So, but Wayne, check it out. Small triggers got through this area, right? So we can't use this area for a strong top. It has to be a no triggers through the area termination. And it didn't reach this area. That's just a target in the distance. So this is a 50-50 that failed. Guys, this is a weak top. But guess what else? It never reversed the market. Those large triggers just kept cranking up. It never reversed the market. So this is why I think language is very important. To be a strong top or bottom, there also has to be a reversal. All right, trick question number 2, guys. Price pulled back to support. It never made the one-to-ones. But the triggers cleared the fib, Steve. Does that make sense? Cool. Price pulls back to support. All the triggers remained above. Here's the weird thing, though. Is the large triggers never even got to roll because they were never down. This is the one exemption to the rule, guys. If you retest an area and the large triggers just never even change direction and keep going up, I feel pretty good about calling that a strong bottom. This is the only time. It's still a termination. The triggers are all still above, but it was so powerful the large triggers could never roll. I love that look. And you'll see a lot of this on a retest. When the market comes off of a bottom or a top and it does this little pullback and you see it. So, all right, right here. Strong top or bottom? Strong or weak? Sorry, weak. Perfect. Strong or weak? Weak. I love it. Here's that exemption, right? Price pulls back, termination, no triggers through. Large triggers never even roll. They just keep going down. Strength all day long, guys. How about right here at 1013? Strong or weak? Strong. Hell yeah. Strong or weak? No. Wayne, termination, and then they roll. It's subtle. This is very strong. This is a good one. Price reaches the area, triggers don't break. There's my reversal. Strong or weak? No. Wayne, price reaches the area. No, there you go. Nice correction. Strong. How about this one from the middle of nowhere? Guys, I love this, and it seems silly, right? Mark's saying the same damn thing over and over and over again. But it's starting to click, isn't it? Strong or weak? It's got a divergence line, guys. Absolutely, it's weak. Because divergence line isn't a termination unless price reaches the divergence line. No, stop trying to make them stronger than the other. Arnie, it's already a termination. It's already reversed the market. Just let it be, brother. Once you start trying to give things power outside of what they are, you're over-engineering. Amen. You're creating scenarios beyond what you need to be successful. And it's dangerous because that's when you start saying things like, well, this pivot stop out says that this area has to break, right? Or this divergence says that it's got to bounce at the mid-band. Screw that. Just make it easy. It's a termination. It never reversed the market. That's a weak top that just created a big untradeable bounce. That's a termination, full bar away, that reversed the market. That's a strong bottom. And understanding how to use it. And look at that. Potential to break and it never did, guys. Potential to break and it never did. And Arnie, are you an engineer? No. So my engineers in here are the ones that overthink things. Our dad's an engineer, so he is the let me make a spreadsheet before we buy the refrigerator kind of guy. And this is why I love to encourage you guys to keep it simple. When do I need to know about a strong top or bottom, right? Well, for a high probability trend trade, it's not mandatory. It's not mandatory, but it's warm fuzzies a little bit. But when does it pay dividends? When I'm taking that more likely trade, that 50-50 trade, and that strong top or bottom says to me that not only did price not make it through this area, right? My triggers didn't break through the area, and it was enough to reverse the market. And then, Arnie, do you need... Whoops, sorry, that was the wrong one to click on. Do you need to factor in the divergences to make this more important? No, you really don't. You're still trading into areas and stuff like that. But 3 divergences can term, so you've got a double termination. But why should this be any more powerful than 2 fibs right on top of each other, right? Let it be a termination. But here's the trick question, Arnie. What if that fib wasn't there? and you had 3 divergences that reversed the market. Oh, strong or weak? Then that would be a strong top. Amen. Everything has the potential. Potential to break areas comes from momentum. Comes from trigger direction, right? This strong top didn't do anything to break this area. This strong top didn't do anything to break this area. Divergence said don't take that trade. Divergence said don't take that trade. This strong bottom didn't do anything to break it at 10.09. But divergence said don't take that trade. Kind of cool, right? It all goes back to rules. So I love a strong bottom. And look at this. No divergence, you got a pretty good bounce. But what's important? What's important is having momentum. What's important is having a clear path, and then from there, find your entry, whatever entry makes you happy. Initially, the high probability trend trade helps you establish risk, helps you minimize risk, helps you optimize profit potential. But guys, S&P is all sorts of consolidating right now. Crude oil didn't have the best momentum. Watch how this goes back to rules, Arnie. You're going to dig this one. Did I have odds favorable momentum right here? Not so much, right? But it's still down. It's a good look. I like it. Clear path all day long, right? So, guys, I'm going to raise my hand in the room right now and tell you, with this look, I would be willing to look for an area inside of favorable large triggers on my small chart, because I would say to myself, guess what? With the tail end of momentum and the clear path, that's 2 out of 3. Let me see where I'm at here. I don't have any areas inside of favorable large triggers. They're all on the wrong side, which means I have to make a decision. Do I wait for a reversal bar, right? And that one I probably end up getting stopped out. Do I re-enter it with the reversal bar and 2 divergences? Pete, there's your small triggers above the large. This one didn't push it up, so now we know we got to find that sample. But weak triggers, anything can happen. And you get caught in between these areas, guys. So the more advantages that you forfeit, the more difficult it becomes to feel confident in what it is that you're doing, what it is you're looking at, especially if you talk to yourself in terms of advantages. Kind of cool, right? Great lessons. Did I miss any questions? You guys ever have one of those days where trading is easy? Where it feels effortless? Where it's almost like you can't lose? I've had days like that. Feels like there's an ATM. Have you ever stopped and looked at your trades from those days? Because when you guys are killing it in this room, do you realize that most of you show me odds favorable and a clear path? And I think that's one of the things that we tend to forget, guys. So becoming a chart reader is imperative. Understanding momentum, clear path, finding your entry is imperative. But what happens when you start getting really good at becoming a chart reader? Does anyone else say things like, and Arnie, this goes back to yours, potential to break resistance. Do you find yourself saying things like, it should, it's going, it will? Where you start to impose your opinion on the market and then take trades based on your reads rather than your rules. And then once again, guys, let me put my hand as high as I can possibly. As high as I can possibly do it. Some of the most dangerous words are it should, it could, it might, I hope. Rules weren't met, but. And that's it. Opinions are, we all know what they're like, right? It could go up, absolutely. But should it make resistance? Hell no, who knows? They can do whatever they want. They've been doing it all day long. So we trade advantages. We trade little ideas that there's patterns that win more than they lose. And guys, Mark Douglas was brilliant in the psychology of trading. Mark Douglas and John Novak worked together for years, talking all the time, almost every day. And there's this idea, and I love this right here, is that when you believe you know what's going to happen, and guys, this is when you let your chart read supersede your rules. When you believe you know what's going to happen, you set yourself up for failure when you take a loss, because now the loss is telling you that you didn't know what happened, and most of us take that very personally. When you don't care what happens, then the trade that you're in doesn't matter, right? I have momentum, I have a clear path, I have an entry area. I don't care what happens. It's either going to win or lose. I'm never in control of that. So it's a collection of trades that you're tracking, guys, not one trade at a time. And I see people change their rules instantly. Well, the mid-band didn't act as a termination condition this time. Well, that fib didn't hold this time. I'm going to trade into it next time. Guys, your rules are an accumulation of 27 years of Fibonacci study. And if your rule says that trading into a fib is a violation of the rules, it means that those fibs hold more than they don't, period. That's it. That's the end of discussion. That's why it is. If your rules say momentum gives you an advantage of a market that's likely to continue, but when that momentum is gone, anything can happen, guys, your rules are designed to keep you safe. And what happens is there's nothing but up and down ticks, and that's how you have to look at the market. Emotional pain comes from what you believe. You create your own pain based on your experience with the up and down ticks. Well, I thought it was going to go up and it didn't. Now I'm angry. Now I'm going to revenge trade. I hoped it would go down, but it went up. Now I'm pissed off. Now I'm going to add contracts on the next shitty trade. And I'll teach that market. I'll teach it to take my money. See it all the time. Done it myself, guys. So define the reasons it may work, right? Momentum, clear path, entry area. And then define where your analysis could go wrong. Well, it's a 50-50 and there's divergence. I'm choosing to take this risk, but that could be the weak point. And be willing to accept the risk by putting your stops where the market should not go before your edge is over. Guys, if you've never Googled Mark Douglas, go watch him. Why would you hesitate if the rules are true? If you believe it, why would you hesitate? Why would you ever hesitate? You assume, believe, or think that you know what's going to happen next, guys. And when you believe you don't know what's going to happen next, it's okay, and you're okay with it. You just take the trade. You don't talk yourself out of it. And the pain of missing the winner is usually worse than taking the loss, and you have to believe that. So when you're fearful, every trade is life or death. Pain on every tick against you, euphoria for every tick with you. And guys, it's exhausting. Your rules eliminate the need to know what's going to happen next. There's your little psychology blast for the day. Momentum's pushing the market. Isn't that cool? What do you guys think? We got some seriously key areas that they have to break before I feel comfortable going long, or some serious key areas that they have to break before I'm going to get real excited about shorts. This is one of those days where I just say, you know what? Give me a clear path beyond this yellow box and all bets are off. Until that happens, I'll let someone else fight it out. I'll let somebody else try to be first. I don't have to be. You never have to be, guys. These are great days to play solitaire and the sidelines. These are great days to draw a picture, to go for a walk. I'm going to give you a couple other things, guys. This PDF file, it's only about 100 pages. It's called Emotion-Free Trading. Wonderful book. I think I've read it about 7 times. And it will say something different to you every time. And then if you go back and read it 30 days from now, it's the same thing. 7 Habits of Highly Successful Traders. My brother told me to read this every day for 30 days. And he was right. It's pretty outstanding. These are the things that, guys, the patterns are easy. I believe that. The patterns are easy. Being willing to do nothing when there's nothing to do is what sets apart successful traders from those of you that are struggling. Being willing to not trade into the areas. Be willing to insist on momentum. Being willing to wait for the market to give you your entry and really avoiding that fear of missing out. So What do you guys want to talk about? I have been flapping my gums nonstop. I'm about to get a phone call from my brother telling me to shut up and make them ask questions. He's done it before too, Cindy. I look over and my phone's buzzing and it's my brother going, dude, shut up. This is a fun one. This was created by a gentleman, and he trades over in the trading room. You've seen him every day, and you can't read his charts to save your life. I haven't. I've never traded a bond market, Arnie. I've looked at stocks on it. I've looked at crypto on it. Never traded a bond market. I feel comfortable saying that it would work. I'm not even sure which data I would need for the bond market, so to be honest with you. Guys, this is something that was created, and Arnie, that's a great question for John Novak, because chances are he has a workspace somewhere for bond markets. If there's one specific, make sure you reach out to him, let him know. Guys, this was developed by a guy, he's been with us about 17 or 18 years, and this is from like 12 years ago. As he was learning the software, one of the things that he did is he focused on not the patterns that were easy, because they become easy once you commit to them. He focused on where his emotions were getting the best. Get the 1 at 11? What does that mean? Oh, I'm sorry, I missed your chart. Thank you, Ron. You guys, sometimes you have to do this. You got to go, Mark, reel it in, buddy. Definitely not a trend trade. So let's see, 50-50 in a consolidating market. Divergence, 2 divergences above the small triggers. Very often it returns to the reversal bar marker. Guys, this is what you start to do when you recognize patterns. Oh, no, Pete, I was wondering, were we talking about this one? The 50-50? Yeah. Where we could pinpoint exactly where it was likely to continue down if it was going to win. And Ron says, I know that rule. Let me catch it on the way up. And then, Pete, that's where I was looking to see if the smalls were above the large, but they weren't even close. That's why I said your name. Definitely not a trend trade. This goes against everything, but it's a pattern that's repeatable for Ron to get paid. So, guys, this was created... you have to know what your thing is. And we all have them. Some of you, your thing is holding on too long. Some of you, your thing is trading in determination conditions. Some of you, your thing is believing you have a 50-50 when there's no momentum in the move. Whatever it is, guys, you got to understand it. But these are some of the most common mistakes. And what this gentleman did is he told himself, if I make one of these mistakes, I have to stand up and get away from my computer, because when you make a mistake, the ego tells you that it's the market's fault, not yours, and you're more likely to take that next mistake over and over. So missing a good trade, when your rules are met and you don't take it, get up and walk away. If you enter late because you don't trust the rules, get up and walk away. If you exit for no reason, 3 minutes out. Moving your stop arbitrarily to lock in profit in the middle of nowhere, not at an area or price action. 5 minutes, guys. Exiting late, giving up most of the profit. We've all done it. That's good. Go run a lap. You're done. Go to McDonald's, get a Big Mac, drown your sorrows. Trading against direction, Ron. Unless it fits your rules. Trading against an area. Trading against area and direction. Get the hell out of the market. Go do something else. I just thought this was kind of cool because this is just something that somebody put together to help hold himself accountable. All right, so Wayne, there are 3 time frames of fibs on the large chart. And you know where they're from by the way they look. So the skinny ones that don't print off to the right, synthetic fibs from other time frames won't go all the way to the right. And they actually won't print until this bar prints. So it looks like you have a clear path, but you don't. The super skinny ones are from the 5-1 chart. The fat ones are from a 21-3, from a higher time frame. Your software actually builds higher synthetic time frames, does all the math, does it for you. Anything that extends to the right is from the native chart. And then this goes back to the idea, is there a good top and a better top, right? Is there a strong fib and a stronger fib? Guys, no. If it's a horizontal line on your chart, divergence, fib, no matter what thickness or distance it goes, 1-to-1s, guys, it can be a termination. It can stop the market. So, Wayne, don't rank them based on where they're from. Just understand that when you reach a line, it can stop the market. And then eventually, who knows, you may say to yourself, I'm going to take the perfect entry on the small chart, but I'm going to hold through a little bit of nonsense for the higher time frame target. So that may work its way into management or something. Yeah, good question. Arnie says, pray for me. You trading gold, Arnie? Yeah. I don't know. Let's see. Odds favorable. Everything says up. Pull back to the mid band. Stops make sense. I never understood why people are willing to lose an extra 20 bucks. It never made sense to me. Arnie, rooting for you, brother. It's a good look. It follows rules. And now we're just going to creep in on your trade. Guys, we got about 15 minutes or so. What do you want to talk about? Guys, this happens on Monday a lot. Let's reload historical and it'll usually fix that. You are at the point of no return, Arnie, right? Intelligent stop placement. Great look on the large chart. It went to the very bottom of those triggers, right? The very bottom of that correction point. Talk about lessons just working themselves out live. Reversal bar has me a couple ticks below. We'll see what happens. Not being triggered as your stop. I like it because it reduces risk. Pete up 1100. Think you're done? Yeah, maybe after lunch they'll change their tone. So Hong, when everything says up, you're going to buy. That's a long trade. When everything says down, you're going to sell. That's a short trade. So since the large chart says up, my only option would be to buy. Over here, where everything said down, my only option would be to sell. Does that make sense? So we're going with the overall trend. And then buy is up, sell is down. And then Paul's about to show you the same entry, Arnie, except he took his from the lower point. Yeah, and that's a good one too, right? Just get on simulator, buy and sell. Just practice, break things. So what you see, I wouldn't even go odds favorable, right? Your large triggers are down. You can see it. But the small triggers are up, C-dub. None of the triggers are through resistance. And this is where you talk yourself into the idea that I should have been in this trade. Watch this. Let me get on that bar. Is that really strong triggers? Not so much. It's not even a clear path, is it, C-dub? But Mark, it still went up. Can't I take this trade? You can do whatever you want, right? But can you see how 60% of the good stuff is already gone. The order history table, Hong, from NinjaTrader? Let me get some orders in there. I'm not sure what you're talking about. The order history through Sim Replay, from Sim Replay. Can you show me a picture of what you're looking at and then I'll help you read it? I'm not sure how to recreate that. Strong look on what, C-Dub? Odds favorable momentum? You tell me. What do you think is better? Let's do it this way. So if your chart looks like this, right? And everything is screaming to the upside. If you have strong triggers here, doesn't that just confirm? Pretty good, right? But here they're not really strong. But this is absolutely screaming. So momentum is defined on the large chart. That's the first step. And if it's perfect and killer over here, maybe I'm okay with a little bit of weakness, right? Maybe I'm okay with the divergence. But what does this weaker trigger and divergence mean? Well, it pushed right through the first area and it made it lower. So I can say to myself, with a little loss of momentum, maybe it goes deeper, maybe it doesn't. But if it's odds favorable on both, that's kind of the best of the best. And Arnie, they're giving you heartburn, brother. But Hong, are you talking about this, the executions? Where are you finding the order history table? This one? There we go. So all this says is, and honestly, you don't need it. It says that you sold gold, market order, quantity 2. It was filled, 54.20, and it was closed. And that's it. That's all it tells you, is what you did. Not really important. I think what's important, if you want to get some good information, go to New and go to Trade Performance. And let me take this picture. And what this will give you, and this is kind of cool. If I go New and Trade Performance, where'd it go? It comes up on the other screen. So I can do a summary and I can just say, okay, I'm doing Sim 101, futures, and I want it to be just for today's date because I want to see what kind of day I had. And once I hit generate, what this will do is this will tell me my total profits, my gross loss, when we started, when we didn't, how many trades, what my percent profitable was, average trade. Okay, so let's do this one, Hong. Okay, that's what I needed to hear. I want you to right-click on your entry chart and go to Data Series and scroll all the way down. And under plot executions, make sure that it says text and marker. And then Hong, what that'll do is that'll tell you where you entered and where you exited. Show me the trade. I mean, the answer is because you made $300 worth of profit and you lost $175 on the other. But if you do that, you can see exactly where you entered and exactly where you exited. If you have a picture of the trade, we can look at the picture of the trade and see where you entered and where you exited. So these markers help you do that when you go back and look at it. And then annotating the charts will tell you what you had going for you. Okay, and that's what I just showed you how to do. Right click on the chart and go to data series and make sure that you put those text and markers in. And then that will, here we go, let me drop this in the room. That'll show you exactly where you entered and exited. And the cool thing is, Hong, is that let's say that I forgot to have it on there, right? And I'm like, I don't know where I got in. I don't know where I got out, but I'm down 70 bucks. I can still right click and go data series. And I can go back and do it after the fact. And it'll pop them in for me. Good question. So if it was on market replay, you're probably not going to be able to go back. But if you were simulating today, you can do that and you'll be able to scroll back and see exactly where you did it. And then Pete, directly into a termination condition. Directly into a termination. Don't know how I missed that divergence. Out for a $50 loss. Time to walk away. Amen. Guys, when there's nothing to do for a while, you'll start fabricating. And then Ron says, crude oil cleared it. A little late, but fast movement. Gets in, gets out. Oh, you did 14. 14 times 4. 140 times 4, guys. That's math. 16.1. 560? $560 worth of profit in a minute. And Ron had to wait all day long for that. And then it finally happened. And now he's going to the beach. Nice one. And then Paul, weak triggers, no areas inside of favorable large triggers. And you take the trade. I hope it worked out for you. So far, it looks like it is. Hong, I think that you're going to hate this answer. I think that the patterns repeat themselves on both. And they move at about the same speed. But they don't always give. Some days crude oil gives more opportunity than the S&P. Sometimes the S&P gives more opportunities. But both of them, I don't think one is better than the other. And I think once you understand the patterns that you're looking for, you'll be able to find them anywhere. All right, Ron, have a good one, man. Go enjoy the beach. We got rain here and no beach, so I probably won't be at the beach today. So, Hong, I think crude oil and the S&P are great learning points. And when the market's doing this, guys, no, I don't think so, John. Just depends on what time it is. But when the market's doing this, scroll back and reinforce your lessons, right? Go back and take pictures of momentum. Go back and take pictures of the gap theory. Go back and take pictures of strong triggers, of strong bottoms, right? John, it depends. In the morning, crude oil can crank. Typically after lunch, after noon Eastern, crude oil slows down. But it also gets going at 2 in the morning because that's when the European markets open. So it just depends. And it depends on the day. Some days, I mean, guys, S&P's garbage today. It happens. It hasn't been like this in a while. I can't remember the last time I watched it consolidate between areas over the course of 5 hours, 6 hours. What does that mean? It means don't trade it, right? If you can't get a clear path, why would you trade it? It's okay to not trade. And guys, this goes back to the belief that the trade that you're in is not the last trade that you'll ever take. The trade that you're in is not the last opportunity for you to make all the money before the market shut down and go home on you at 9 in the morning. If there's no rules met, don't trade. If they're met, trade. Let that be why you enter the market. Man, gold decided to go a little bit. Narni, it looks like your stops may have kept you safe. I don't know if you could sit through all that. Ugh. And then there's that crude oil. Mid-band held for the first hit. Still in it? We'll see what happens. You never know. Guys, we got, well, shit, pardon my French, it's 11:54.